Chalo, chalo. Good evening, everyone. Good evening. Am I audible? My audio video screen is visible, I hope.
Yes, sir.
Yes. Okay, chalo. Yes, yes. So today the agenda will be to do consolidation, then your IAS 37, IAS 10, IAS 8, and IFRS 13. So yesterday we have completed IFRS 16, IFRS 15, financial instrument, IAS 12, IAS 33, and IAS 21. So now first, we'll start with consolidation and then we will do the remaining standards, the small standards which we have. We have to do cash flow also. We'll do cash flow also. So once done with consolidation, then we'll start with small standards and at last we'll do cash flow. So let's wait for one more minute. We'll start at 6:10. Interpretation is done, sir. No, 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 no. Interpretation we have not done. Conceptual and regulatory framework we have not done. So we'll try to keep a session on Monday. So there I'll discuss. Monday we'll have a 2 hour session. So I'll cover the conceptual framework and interpretation there. Interpretation, Raj, in the class we have already done the 10 questions and I've explained each and everything. So now here I will revise the ratio and I'll mention you some important tips so that we can have a session tomorrow. I planned that we can complete the syllabus in 9 to 10 hours, but it is difficult by with each topic taking a basic example, it becomes difficult. That is the reason. So tomorrow we'll have a 2 hour session. In that we'll do conceptual and regulatory framework and we will do your interpretation. Understanding interpretation I mentioned. Normally what is important? Linking to the case is very important. And in the class when we have done 10 questions, in each and every question we have seen that your gross profit margin, net profit margin, ROCE, gearing, these were the 5 to 6 ratios which were frequently tested. And we have seen what? Everything, the data will be given in the question. You have to use that data and write down in simple words. One simple sentence is 1 marks. Good evening, others, if you have joined late. Chalo now. So today the agenda will be, as mentioned, we will be discussing consolidation. After this, we have IAS 7, your cash flow. Then you have your IAS 37, IAS 10, IAS 8, and IFRS 13. IFRS 13 will not be tested in detail, but the basic knowledge you should have. So now, chalo, let us start with consolidation, an important topic for your FR in the section C as well as section A, MCQ question. And in section A, a lot of MCQ questions will be regarding what? Allocating the profit or loss to the parent or NCA. We have seen that. Now, chalo, starting with consolidation. Consolidation basically means what? A company is there, B company is there. A company has purchased more than 50% shares, then we say it has a control. So this A company will become what? Parent, and this B company will become a subsidiary. So A and B company will do what? A and B company will prepare a Thus, A will be a parent, B will be a subsidiary. Then A company will prepare consolidated financial statements saying that these two, that is A entity and B entity, are one only. So that means consolidation is prepared when we have control. So now see, starting with the first basic definition. Consolidation definition: business combination. What does business combination means? A transaction or other event in which the acquirer obtains control of one or more business of the acquiring. So what does the term acquirer means? Acquirer means the parent or the investor, an entity which controls one or more entities. Then coming to the next one, what does the term control means? A very important topic for theory. We will discuss this. Then one or more businesses. It should be a business transaction. It should not be asset acquisition. So parent is also known as acquirer, investor. Subsidiary is known as investee and acquiring. Acquiring or subsidiary is an entity which is controlled by another entity. Now, what does a group means? Group means parent and subsidiary. Group associate will not form a group. Understand that. Acquisition date means what? The day when the acquirer obtains control of the acquiring. Then, sir, what does consolidated financial statement means? As I've mentioned the example, A company, B company. What will A company do? A company will prepare its individual financial statements. B company will prepare its individual financial statements. Then once A company will acquire B company, if I say 50%, then A company will do what? A company will show in its balance sheet as investment in B. Then this will be known as separate financial statements. Then A company will do what? A company will prepare consolidated financial statement, assuming that these two entities are one. When you prepare the consolidation, goodwill will arise, NCI will be there, etc. A lot of things. So, consolidated financial statement, the financial statements of a group presents as those of a single economic entity. It is a single economic entity. That is the reason we eliminate the intra-group items here. Then coming to the non-controlling interest. What will happen in what does non-controlling interest means? If A company has A company has here 51 percentage. That means the 49 percentage will be known as what? NCI. As the A has control, then the other shareholders will not have control. So those are known as NCI. So the equity in the subsidiary which is not attributable directly or indirectly to parent, which does not belong to parent company, which belongs to the subsidiary parent to NCI. So now what are the types of investments? See, if my shareholding is less than 20 percentage, we will apply IFRS 9 financial instrument. Under that equity instrument, you have two methods. You have fair value through P&L, fair value through OCI. If it is 20 or more, but up to 50%, then we apply IAS 28 equity accounting. Equity accounting will say in balance sheet you have to record investment in associate or the carrying amount of the investment of associate. Then in P&L we should record share of profit from associate. Then if it's more than 50 percentage, what will follow? IFRS 3 and IFRS 10. That means consolidation we follow. We do consolidation. IFRS 3 is not that for you. Here and there some points are there. We have to know that. So now coming to the first point, statement of financial position. How do we consolidate? So how do we do the consolidation statement of financial position? We'll add everything. We will remove what? The equity part of the subsidiary. We will remove the investment in subsidiary company. And everything will add. We show goodwill and we show NCA. So see, consolidated statement of financial position will show what? Net asset of whole group, that is P plus S net asset. Then share capital of group, which always will be equal to the share capital of P only. The equity part will only be equal to the parent company. For subsidiary company, post acquisition retained earnings, post acquisition revaluation surplus will be taken and it will be given to parent and NCA. Then retained earnings will include what? P company's profits and P's share of post acquisition profits will be included. So see, a basic example we have seen in the class, we had taken the example of Geo and Reliance to understand how basic consolidation is done. So now here see, P company is the S company. P company assets, everything is given here. So P company mentioned that we have invested in S company. How much? $10,000. So what is the value of the equity here? 10,000. That means full 100% acquisition is done. So in that case, what we do? We eliminate these two things and we prepare the consolidated financial statement. We add each and everything. So what is the journal entry we record? When a company will invest in the company, they record what? Debit, credit, debit, investment, credit, cash, or deferred consideration, contingent consideration, or share exchange. So what do? We remove the investment, we remove the we bring in asset, we bring in liability, and whatever is the balancing figure will be your goodwill, will be your goodwill. Either it can be goodwill or gain on bargain purchase. Understand that? So see, if it's on the credit side, it becomes a gain on bargain purchase. This is an income for the parent company because they are paying less amount, but the value which they are getting is more here. So P company as company, if 80% is controlled, can I say 20% will be shown as NCA? So what we do? Asset is coming in, liability is coming in, sir. Goodwill will be there on debit side. If it's a goodwill, credit side will be what? Gain on bargain purchase, and you'll remove the investment, and NCA also we have to show. NCA will be shown in the equity part as a liability. So I hope this is clear to everyone. Now coming to the type cost of investment. Now whenever companies purchase, what are the consideration which is paid by the parent company? So the first one is what? Cash consideration. Cash means we directly transfer the amount from the bank account. Then deferred consideration. Deferred consideration means what? The payment is done in future, and the payment which is done in future is not based on any condition. It's an unconditional payment. Then share exchange. That means parent company is acquiring subsidiary company. Then parent company is doing what? Parent company will give the shares of parent company to the subsidiary company. P company will acquire S company shares, but they'll say that we do not have cash. Parent company will say that we will give the shares of our own company to you. Share exchange. Then contingent consideration. Contingent consideration means payment which is done in future, but it is depending on an event. It depends upon a event. It depends upon an event. They achieve the target, this will be paid. Then fixed asset consideration, as mentioned, it's not so important for FR, but just for understanding purpose, I have mentioned it. Fixed asset means what? Parent company is selling an asset to the or giving an asset to the subsidiary company. So whatever is the fair value will be considered as the cost of investment, and the asset will be removed at the carrying amount. Whatever is the difference will be the gain or loss. So see here, the first consideration, cash consideration, debit investment, credit, cash or bank, we record this. Yes, sir. Share exchange. Now share exchange, what we do? Debit investment, credit share capital, and share premium. Most of your questions regarding consolidation, the cash adjustment will be done. In a lot of questions, we have seen deferred consideration, share exchange, and contingent consideration would have not, the adjustment would have not been done. So we have to do it. The adjustment should be done. So what is share exchange, sir? How do we calculate share exchange? So we take the in question, if the number of shares are given, then no issue. But most of the time you have to calculate the number of shares which are given by the parent company. So what we do, we take this share capital of subsidiary company, whatever is the total share capital of subsidiary company, then we divide what? Face value of subsidiary shares, whatever is the face value, so that we get what? The number of shares. And we divide the face value of the subsidiary shares, because whatever is the premium will be recorded in share premium, that will not be recorded in share capital. Understand? Share capital will be based on the face value into what? Percentage acquired, 70%, 80%, into exchange ratio. That is, for every 5 shares you have acquired, we are giving 2 shares. So ratio is 2 is to 5. So we'll apply this, we will get this ratio. In that case, this will be what? This will be the number of shares issued by P company. Into what we do? Into we do fair value of the parent's share price. Whatever is the parent company share price, we will take into consideration. Now in most of the question, investment, this would have not been recorded, so you will go and increase the investment, again you will reduce. So but important is what? Share capital and share premium, you have to do the adjustment. So example, see, the share capital is $100,000 divided by $1 into 80% into 2 divided by 5 into 2. So it's almost $64,000. Then we do what? Debit investment 64,000. Credit share capital. Share capital should be on face value. I mentioned the face value is 1 and the price is how much? 2. So the remaining will go to share premium. So parent company will increase share capital by 32,000 and share premium by 32,000. So read the question carefully. It will be written above only whether the adjustment is done or not. Next, deferred consideration. Deferred consideration means what's a promise to pay an amount in future, but the amount is determined today only. That amount will not change based on some future event. So in that case, what we do, we have to consider the time value of money. We have to discount it and record it. So debit, investment, credit, deferred consideration. So this deferred consideration will belong to parent company. Understand? So parent company will record as a liability, non-current liability. And over the years, what should we do? We have to unwind it. So debit finance cost, credit deferred consideration. Now this finance cost is an expense for which company? This finance cost is an expense for parent company. So when the parent company is preparing the P&L, it will be recorded as a cost. If consolidated P&L is prepared, we record it as a finance cost in financing category. If consolidated balance sheet is prepared, your SOFP is prepared, in that case, we take this to retained earnings. Your step number 5, group retained earnings. See a note. Every year, unwinding of discount should be done. The impact of finance cost will be adjusted to parent's profit and loss, that is consolidated retained earnings. It will be shown under goodwill side. It will be shown under the liability side of the consolidated financial position as mentioned to you. If see, we'll be learning the balance sheet part first. What are the adjustments that you should do in balance sheet? And again, those adjustments we'll learn for P&L also. So as of now, in balance sheet, where will you adjust? Consolidated retained earnings. And in P&L, financing cost. Then contingent consideration means a amount that is payable on the basis of a future performance. If the performance is done, in that case, if the target has been achieved, then Reliance company will say to Jio that we will give you this amount. In that case, we have to consider this is a conditional promise. So the difference between contingent and deferred consideration is what? Both the side payment should be done, but deferred consideration is not based on some condition. Contingent consideration is based on some condition. So debit investment, credit contingent consideration. So this will be required the fair value. In your exam, the fair value will be given. Do not worry much. So note, contingent consideration should be recorded at fair value at the date of acquisition. Subsequent changes are reporting date. Now this is also an impact for which company? This is an impact for parent company. So parent company retained earnings will be affected. If you're preparing balance sheet, if we are preparing what? P&L, the P&L will take a hit. We'll see in which category later. So now it should be shown under the liability side of the consolidated financial position in SOFP. Then sir, if the value of the contingent consideration is decreasing, that means it's a gain for us because the value of the liability is decreasing. So we record what? Debit contingent consideration, credit P&L or retained earnings. Then what we do on the, if contingent consideration value is increasing, so we credit contingent consideration and we debit P&L or retained earning as a loss. So then fixed asset consideration means what? If a parent company is transferring a fixed asset as part of the consideration, so we record investment, we remove the asset, and any balancing figure will be the gain or loss. I have not seen this being tested. You in your FR, four things are important which we have covered. Now chalo, any acquisition cost when you are acquiring a subsidiary company, in that case some legal fees or commission should be paid, etc. A lot of things. In that case, where it will be recorded, in case of P&L in operating category, you record it as an expense. But when we prepare balance sheet, where should we adjust? We should adjust in consolidated retained earnings. Where should we adjust? Consolidated retained earnings. Then all the assets and liabilities of the acquiring company are to be acquired at fair value. Whenever we acquire any company, what do? We acquire that company at fair value. All the assets and its liability. These are the some basic points. Now coming to the steps, 5 important steps. Every time you have to do this. If an associate company is there, we will prepare the working note number 6 also. So what is the step one, sir? Group structure. First, you have to determine group structure. What is the percentage we have acquired? Date of acquisition and reporting date. Why do we do this? Date of acquisition, reporting date, so that we get to know whether it's a mid-year acquisition or not. If it's a mid-year acquisition, then we have to adjust the retained earnings. Remember, an important part. So example, 80% date was on 1st Jan, reporting date is 31st 12, or it could be 30th 9, anything. 6 months, 9 months, 12 months, 11 months, 12, 10 months, depending upon the data which is given in the question. Then step number 2. In step number 2, what do? We write down net asset of subsidiary. Why do we do this step number 2? To calculate the post acquisition profits, so that we get to know once I acquire the company, the profit will be given to parent and that profit will be given to NCI. So here it's only the post acquisition profit. So what we write down? Share capital, share premium, retained earnings, revaluation surplus. We write down each and everything here. Now, in your FR exam, share capital, share premium most of the time will remain same. It will not change. 100% it will be same one. Retain earnings, closing balance will be given. Opening balance also will be given in the question. So read the question carefully and take the value. Sometimes what will happen? You acquire the company on 1st July, but the retain earnings would have been given on 1st January 2024. So what should you do? So this year profit is 100. So what should you do? 50 you should add it. So the value will be how much of retain earnings? 150 on the date of acquisition. So the closing will be how much? 200. So the post acquisition profits how much? 50. Then see, then fair value adjustment should be done. Let us read the URP, excess depreciation, dividend paid. We have to do a lot of adjustment. So, but let us start with the, so the difference which you get is what? Post acquisition profits. Then note, some important notes. Whenever we acquire any company, all the assets and liabilities of the acquiring are to be taken at fair value on the date of acquisition. We know that. Now, sometimes the fair value adjustment would not be done in questions. For sure, if you have a consolidation, for sure for 2 to 3 marks fair value adjustment will be there, and it's a very simple and easy area to score marks. So please do this proper. Either the fair value will increase, either the fair value will decrease, or the question will say what regarding inventory fair value. So let us discuss now. Example: asset is recorded at a carrying amount of 1000, but fair value is what 1300. So 300 should be adjusted, yes or no? So what should we do? Sir, we should increase the value of the asset on the date of acquisition. Because if we increase the asset, my equity value also will increase. Asset is equal to liability plus capital. Then, sir, on reporting date, what should we do? On reporting date also will increase this by 300. And then what we do? Then can I say we will charge the depreciation here? So on this 300, if I assume 6 years is the useful life, my depreciation will be 50. So my ultimate increase will be how much at the reporting date? The value of the asset will be 250, and this 250 should be adjusted in the consolidated balance sheet, because the adjustment is not done, we have to do it. So this is for depreciating asset. For non-depreciating asset, what should we do? We should directly take the value on date of acquisition and reporting date. No issues in this. So this is the first example where the fair value is increasing. The second example, asset is recorded at a carrying amount of 1000, but the fair value is how much? 700. So the value of the asset is recorded in the books how much? 100,000, but the value is how much? 700. So there is a decrease in the price. So if there is a decrease in the value of the asset, can I say the value of the equity also will come down? Net asset value will come down. So you take that. Here also you will take 300. But can I say the depreciation should be on 700? But the company has charged the depreciation on 1000. It's wrong. So what we do, there is a saving in depreciation here, 10 50. So when you add this, the ultimate reduction in the balance sheet should be how much? 250 consolidated financial statements. And for non-depreciating asset, it's very simple, 300 minus 300. So this is the fair value adjustment. The next one, fair value adjustment for inventory. So it's a very important, many students will make mistake in this, so please concentrate here. So fair value, so normally we have learnt IAS to inventory will be recorded at what? Lower of cost or NRV, yes or no? Now, if the subsidiary company is recording at cost or NRV, can I say we have learned NRV is entity specific, but fair value is market specific. So can I say we have to bring this inventory to fair value? So then what we do? Subsidiary will increase inventory. Subsidiary will measure inventory at lower of cost or NRV. If the fair value on the acquisition is high, then it should be adjusted on the date of acquisition in step 2. So see here, if I say the cost is 100, fair value is how much? 120. So the increase is how much? The increase is 20. So on the date of acquisition I'll include 20. On reporting date, what will I do? I will include 20. Why 20? Because the inventory is not sold, full inventory is there. So what we do, we take the full value 20 and 20 we add it. So there will be no issues in this. But if I say the full inventory is sold, so on the date of acquisition you increase by 20, on reporting date also 20, but again we'll do reduce 20 because we are selling it. Once we sell the inventory, will there be any value of the inventory in the balance sheet? No value. Then next one, then 20 on the date of acquisition. If half of the inventory is sold, if half of the inventory is sold, can I say remaining half will be pending? So in your question you have to see 30 percentage, 40% which have been sold. So the inventory which has been sold will not be included on the reporting date. On reporting date will include the fair value of the inventory not sold. So out of 20 we have sold 10, so remaining is 10. So we have recorded the sale. Now a question comes, sir, automatically the impact will be taken in post acquisition profits. Automatically it will be taken care, no problem in that. Then chalo next one. So with this the fair value adjustment is clear to everyone. Then coming to some recognition exemptions, exceptions or exemptions, you say intangible asset. So normally what will happen, we have seen IAS 38, when a subsidiary company is there, subsidiary company will not record an internally generated intangible asset. Why? Because it is difficult to measure the amount. It's difficult to measure the amount, so that is the reason the subsidiary company will not record internally generated your brand, your intangible assets. In that case, what should we do? But when we do consolidation, when I purchase the subsidiary company, I know the cost which I'm paying for the brand. In that case, this brand should be included in the consolidated books. So what will you do? You will increase the you will add the intangible asset on the date of acquisition, and at reporting date also you'll add it, and you will see whether there is any amortization or not. If there is any amortization mentioned, so the value will be reduced here. Then contingent liability. Normally contingent liability, what we do, contingent liability as per IAS 37, we normally disclose only. Accounting treatment is not done. Accounting treatment is not done. Excellent. Any contingent consideration in subsidiaries book should be recorded as provision on the date of acquisition. So subsidiary book will record what? Contingent. They will only provide a disclosure in the notes to account. But as a parent company, when we prepare consolidated books, what should we do? We should include that value. So if we include this value, it should be at fair value. So in that case, will it increase the value of the net asset on the date of acquisition? No. It will reduce the value on the date of. It will do what? It will reduce the net asset on date of acquisition and reporting date. Understand that. So research cost. So research cost, normally what will the subsidiary company do? Subsidiary company will normally record into P&L as an expense. But when a parent company is purchasing a subsidiary company, and the research cost will provide a benefit to parent company, and if it meets the definition of asset, then they should record it as an asset. If not, no issues, nothing should be done. So I hope this step number 2 is clear to everyone. So see here, I mentioned here, fair value adjustment on the date of acquisition. Then what do you do? Then you see, here also you do, and then you reduce whatever is the depreciation, amortization, etc. Anything, the decrease in value or increase in value. So then coming to step number 3, sir. Step number 3 is what? Goodwill calculation. Step number 3 is what? Goodwill calculation. So goodwill calculation have how many methods? There are two methods for goodwill calculation: proportionate net asset method and full goodwill method. So in the exam question, it will be mentioned which method is the, or which method the company is using. So in case of proportionate net asset method, what is the first thing we write down for goodwill calculation? Purchase consideration, that is the cost of investment. Four things we have learned: cash, deferred consideration, contingent consideration, share exchange. Then you add what? Proportionate share of NCI. You will not take the fair value here. You will take the net asset value on the date of acquisition, and you will multiply the NCI percentage. You multiply the NCI percentage. You take this. Then what's less fair value of net asset on the date of acquisition. You will reduce the fair value of the net asset which we have calculated, the same amount which we have used. You calculate this, you get goodwill, or you will get gain on bargain purchase. If it is a goodwill, where will you show? If it is a goodwill, we show under non-current asset. If it's a gain on bargain purchase, then you will directly take to P&L as an income. If you're preparing P&L, if you're preparing your balance sheet, it will go to retained earnings of the parent company. So less impairment. Now, can I say in proportionate net asset method, the impairment will only belong to it will only belong to parent company here. You write down this, you get goodwill on reporting date. You get goodwill on reporting date. Then full goodwill method. In case of full goodwill method, here the goodwill will belong to parent and NCI. So purchase consideration, instead of taking the percentage of the net asset, we take what? Fair value of the NCI on the date of acquisition. Fair value of the NCI on the date of acquisition we take, less fair value of the net asset on the date of acquisition. Goodwill you will get recording non-current asset. If you get gain on bargain purchase, it will go straight forward to P&L or retained earnings. Less impairment. This impairment will be allocated to NCI and parent written both. So you will say goodwill at your reporting date. This is the value which you will be getting. Now note, what are the, if goodwill is positive, it will be treated as non-current asset in consolidated financial position. If goodwill is negative, it will be treated as a gain and included in the consolidated retained earnings. Then, sir, fair value of the NCI on date of acquisition, a lot of time in the exam question, it will not be mentioned. So what will you do? You will take the number of shares held by NCI into the fair value of the subsidiary. When we did the purchase consideration, we had taken parent share price. Here we will take subsidiary share price. Then coming to impairment of goodwill. Proportionate methods are only given to which parent company? So consolidate return. So full goodwill method, it will be given to parent, it will be given to NCA, and the goodwill value will reduce. Step number 3 is done. Then step number 4. In step number 4, we do what? NCA calculation. So what we do? Proportionate net asset method. We proportionate net asset method. In this case, what we do, we take fair value of the net asset on the date of acquisition into NCI percentage we apply, then add NCI share of post acquisition profit. How do we get this? This we'll get in step number 2. Now understand here what I mentioned, post acquisition reserve it is. So both revaluation surplus, if a subsidiary company is that once we acquire, that is a revaluation surplus, that revaluation surplus will be allocated to parent and NCA. Then full goodwill method. In full goodwill method, what we do, fair value of the NCA will be given in the equation. If it is not given, you take the number of shares of the NCA into subsidiary share price. Then what do you add? NCA share of post acquisition reserve. Then less what? NCA share of impairment. You get what? You get NCA at reporting date. You get NCA at your reporting date. Then coming to the last step, step number 5, group retained earnings. So what should we do here? You see, you take P's retained earnings 100%. You take then P's post acquisition profits in S company less what? Share of impairment. In case of full goodwill method, percentage you have to consider. In proportionate method, only the a full amount will be allocated. Then any deferred consideration and less contingent consideration. If deferred consideration, the interest cost, you less here. Contingent consideration, you have to see whether the value is increasing or decreasing. You will do the adjustment. Then less URP excess depreciation, we will do this now. So you'll get your group retained earning. These were the 5 steps, which is very important. So now chalo, let me start with intra-group trading. So intra-group trading, in this case, what will happen? If P company is selling to S company and P company is selling to S company, then which company is recording profit? P company is selling, cost of goods is 1000, sold for 1500. So the profit is what? 500. This 500 is what? URP. Why it is a URP? Because subsidiary company has not yet sold to anyone. If subsidiary company would have sold to anyone, then case URP will not be there. So URP will only be on the goods which are not sold. So 500 is the URP. Now this URP, who has recorded the profit? Parent company has recorded more profit and subsidiary company has recorded more inventory. So what we do? We go and reduce the parent company's profit and we reduce the inventory value. So you see, reduce consolidated retained earnings because parent company has recorded more profit. That profit would have been transferred to retained earnings. So now we reduce it and group inventory. So this is journal. So understand markup and margin. In case of markup, sales cost will be 100% and the sales value will be more. And in the exam question, if it is written cost plus, then understand it is what? It is the case of markup. In case of margin, what will happen? So cost is 75%, but the sales value is what? 100 and the profit will be the this 25. This is case 1. In case 2, what will happen? If subsidiary is selling to parent, sir. If subsidiary is selling to parent, in that case, what will happen? Subsidiary company is recording more profit. How much is the profit? Sir? 500. Understand, URP will only be on the unsold goods, the goods which are not sold. So this 500, subsidiary company recorded more profit and sir, parent company recorded more inventory. So what we do? If subsidiary company is recording more profit, can I say if subsidiary company is recording more profit, it will affect parent plus NCI both. So what should we do? Reduce URP from the net asset at the reporting date. That means you will reduce the subsidiaries retained earnings. How will you reduce? You will go and in the step number 2 at the reporting date, you will reduce the amount and your group inventory so that the effect is removed. So this was the intra-group for P2S and S2P sale. Now coming to intra-group sale of non-current asset. If P is selling a non-current to S, in that case, what will happen? See here. Parent company is selling a non-current asset to S company. So the cost was for P company. Either it could be cost or carrying amount. Assume cost or carrying amount. In that case, what? 1000 we take. 1000 is the value. What is the sale value? 1500. So profit is how much? 500. Which company recorded more profit? Parent company recorded more profit. Subsidiary company recorded the value of the asset more. So first thing we do what? Reduce the URP from the consolidated retained earnings and group non-current asset. Group non-current asset. But then sir, as per the carrying amount or cost, how much should be the depreciation? The depreciation should be 200. But the subsidiary company recorded how much depreciation? 300. So 300. In that case, what we will do? So excess depreciation will be how much? 100. This 100 is the excess depreciation recorded by subsidiary company. So what we do? Subsidiary company recorded more depreciation. More depreciation means the profit of subsidiary company is low. So what we do? So we add excess depreciation to the net asset at the reporting date and group non-current asset. You will increase the group non-current asset also. So you see here, increase the group non-current asset and reduce the retained earnings of the subsidiary in the working note number 2 or step number 2, which you say. So with this, the first case is clear to everyone, P2S. Again, we will repeat this in your P&L. In P&L, how will you do the adjustment? Sir, S to P sale. Now, S is selling a non-current asset to parent company. If S is selling, S is recording more profit. Parent company is recording more depreciation. So profit is recorded by S company, parent recorded value of the asset more. So what we do to remove the impact of profit, S company will reduce its retained earnings on the step number 2 on the reporting date, and we will reduce the non-current asset. Parent company will reduce the non-current asset. So reduce the URP from the net asset of the subsidiary at the reporting date and from the group non-current asset, from the group non-current asset. Understand? Then, sir, excess depreciation. What should we do for excess depreciation? Which company is recording excess depreciation? Parent is recording this time. So parent company is recording more depreciation. That means parent company profit is low. We have to increase the profit of parent company. How do we increase the profit of parent company? By adding this to the cost of, by adding this to the group retained earnings. So debit, credit group retained earnings and debit non-current asset. You will increase the value of non-current asset. So add excess depreciation to the consolidated retained earnings and group non-current asset. Group non-current asset. Then, sir, with this, the intra-group sale is done. Then intra-group loan. I have not seen a question regarding this in detail for the adjustments also. But remember, if by chance, if the examiner gives you a new adjustment, you will be able to do. Normally, what you have learned, sir, parent company, the subsidiary. Parent has given a loan, subsidiary has taken the loan. Parent company has given, subsidiary company has taken. So in this case, parent company will record what? A financial asset. Subsidiary will record a financial liability. When we do consolidation, we have to remove these. Intra-group items will be eliminated. Will be eliminated. But sir, parent company will record what? Interest income. Subsidiary company will record interest expense. Normally, this is tested in your P&L. But by chance, if it comes in balance sheet, how should you do the adjustment here? Sir, parent company recorded interest income. So parent company retained earning is more. So we reduce the consolidated retained earning. So subsidiary company recorded expense. If they record expense, when they, that means what? Sir, the retained earnings of subsidiary companies less, we have to increase it. So we subsidiaries retained earnings is increased. So reduce interest amount from consolidated retained earnings and add the interest amount to the net asset of the subsidiary at reporting date. Case 2, subsidiary to parent. In subsidiary to parent, subsidiary company will record income. So what we do, so and parent company will record expense. So we do what? We reduce the your retained earnings of the subsidiary company, and we increase the retained earnings of the parent company because parent company is paying the interest here. So add the interest amount in the group retained earnings, step number 5, and reduce the interest amount to the net asset, to the net asset of the subsidiary at reporting date. So with this is completed. Now coming to the next topic known as intra-group items, which is a frequently repeated topic in your FR for your consolidation. So see now, intra-group receivable and payable should be eliminated. Any intra-group item, it could be what, sir? It could be your in loan given. That also we have seen. We remove it. So we remove this part also. So see now, at the year end, see sometimes what will happen? Parent company subsidiary. Parent company has a receivable, subsidiary company record a payable. So no such issue. We remove this. We remove this. No issues in that. But sometimes what will happen? Parent company say that I have a receivable from subsidiary 10,000, but subsidiary company saying that we have to only pay 8,000. Then that is a issue. Either there could be goods in transit or cash in transit. So now, if I say this is because of a cash in transit, that means subsidiary company has paid, but parent company did not receive. So what we do, we simply go to the balance sheet and remove 10,000 from receivable, we remove 8,000 from payable, and we simply increase the cash amount. We simply increase the cash by 2,000. This is what cash in transit. Now the other way around, the other way, if I say parent company sold goods to subsidiary company, that means what? Parent company sold goods to subsidiary company on credit. So they mentioned that our receivable is how much? 10,000. But subsidiary company has not recorded this purchase yet. So that means what? Subsidiary company payable will be low. Yes, sir. This 2000 is low because of what reason now? Goods in transit. So we do what? We just go and remove this 10,000 from the balance sheet as a receivable, and from payable we remove 8,000. This 2000 will be recorded as what? Goods in transit in your inventory. In your inventory. A very good question is that pyramid question which we have done, in that we had both the adjustments, goods in transit, cash in transit. So please do refer once if you have doubt in this. So cash in transit, debit cash, credit receivable. So we do what? We try to increase the balance of receivable. So see, trade receivable is how much, sir? 80, and trade payable is 80. That means what? Subsidiary company has paid the amount but parent did not receive. So parent company will do what? Parent, we remove the trade payable 80, we remove trade receivable 80, payable 80. Then what? We are receiving the cash, so we remove the receivable further by 20 and we record cash in transit. If it's goods in transit, so we increase the inventory and we increase the payable. So either what you can do, you increase the payable and then the amount is equal, you eliminate, or directly you eliminate and increase the goods in transit and cash in transit. So I hope everyone have understood this. Then the next part, dividend payment. Dividend payment by subsidiary company. If subsidiary company is paying dividend, what will happen? Can I say subsidiaries companies group retain earnings will subsidiaries company retain earnings will be low. So you do what? Add back the dividend payment by subsidiary company to the net asset at the reporting date, your step number 2. And as subsidiary has reduced the retaining, then what will the parent company do? Parent company, then what we will do? We will normally record the profit, then we'll get the post acquisition profit. This post acquisition profits will be given to parent and NCA. But parent company has recorded this income, but this income has been realized, we have taken this, so we reduce, parent company will reduce its portion of dividend from the step number 5. And we will do what? In NCA calculation also, if the dividend is paid, we remove the NCA value, we reduce the value of the NCA. And if it is not paid, we record this as a liability. We reduce the part and we record it as a current liability, that the dividend is payable. So now, if a dividend payment by parent company, if dividend is paid by parent company, then no need to do any treatment. It will be done in separate financial statements. If the company is acquired between reporting period as mentioned, then the net asset at the date of acquisition should be time apportioned. That means especially the retained earnings. You have to properly calculate the value. So with this, we have completed the revision of your balance sheet part. Any doubts, anyone? I hope you are able to remember all these points which are frequently repeated. Each and every point we have covered. Okay, better. Then coming to statement of profit and loss. In case of statement of profit and loss, what we do? The standard approach is what? Each and everything we will add it. We'll add the revenue, income, expense, everything we'll add. Then what we do? First, we do group structure, add each and everything of parent and subsidiary, then do the working, remove the intra-group items, and then do what? NCA share of profit. Very important. You have to do this. This, if a P&L question comes, it will be for 2 to 3 marks. And mention that IFRS 18, the new standard has been introduced. In that case, the chances are very high that you get consolidation of P&L or you get a single entity question. It will be for P&L only. Understand that? So see here now. How do we do here now? Sir, example, parent company, subsidiary company, each and everything we added. Yes, sir. Now, what is the total profit? 1,200. Now, out of the 1,200, profit belongs to owners and the NCA, that is the parent company. So now, to calculate the profit of NCA, will the 600 belong to NCA? No, only subsidiaries profit will belong to NCA. So the 600 I take into 40 percentage. I say 360 belongs to NCA, and the remaining will belong to parent company. So 840 belongs to parent. This you do for profit attributable. Same you do for total comprehensive income also. For equity owners, NCA and total comprehensive income. The total comprehensive income will include this 1,200 plus revaluation surplus or fair value through OCI. These are the two adjustments which will be tested in FR. Other than this, nothing will be there. So this is done. Now see, how do we calculate NCA share, sir? NCA share, what do you do normally? Sir, we take subsidiaries profit after tax. Then what we do? Less adjustments like your fair value depreciation, saving is there, URP, impairment. Then we calculate the value and this value will take and will multiply with the NCA percentage. We get the NCA share of profit. Now see, value, fair value adjustment. Now whenever there is a increase in the value of the asset when we acquire, so can I say excess depreciation will be there? That excess depreciation will take a hit for subsidiary company. So I say the fair value is increasing. If the fair value is increasing, that means what? So the depreciation will increase. If the depreciation is increasing, profits will come down. So what we do, this 10 is an increase in depreciation. We have to reduce the profit. How we will reduce the profit? 10 is added to the cost of goods sold. So you increase the cost of goods sold, automatically the profits will come down. And this 10 you have to reduce from the subsidies profit after tax for NCA calculation, because this 10 will also take a hit for NCA part. Then saving in depreciation, if the fair value is decreasing, whenever there is a saving, that means what, sir? Profit should increase. How will you increase the profit? By reducing the cost of goods sold. So the 10 is reduced from the consolidated cost of goods sold and add to S profit after tax for the NCA calculation, because 10 is a saving, so that should be added there, so that the profit out of this 10 is given to NCA also. Then, sir, fair value of the inventory. In case of fair value of the inventory, what do we do? Whatever is the value of the inventory which we have sold, you will consider that. So increase the cost, consolidated cost of goods sold by the fair value of the fair value of the amount of the inventory sold, and decrease the subsidies profit after tax for NCA calculation. Because the fair value of the inventory is increasing, that means cost is increasing, profit will come down. So we do what? We decrease this amount from the subsidies profit after tax for NCA calculation. Then sir, intra-group items. Intra-group items. Chalo. What is this? A frequently repeated adjustment in case of what? In case of P&L. So now case one, parent company is selling to subsidiary company. If parent company is selling to subsidiary company, what will happen? Sir, who is recording URP? Parent company. But what is the first thing you have to do? Parent company will record revenue, subsidiary company will record purchases, so we have to eliminate it. So when you do the elimination, you will not use the URP, you will use the transaction amount. So reduce the consolidated revenue and cost of goods sold by transaction amount, that is 500 here. Now how much is the URP? Can I say the URP is here 300? So who has recorded the profit? Profit is recorded by parent company. See, URP will only be calculated on the goods which are not sold. Excellent. But the revenue and cost of goods sold you will reduce by considering what? By considering the transaction amount. And do not do a mistake in the cost of goods sold. If the cost of goods sold is minus written in brackets, again do not write down minus. It will add it. The treatment will become wrong. So be aware of signs. Silly mistake which you should avoid in the exam. So URP, sir, which company is recording, sir? Parent company. So parent company has recorded more profit. We have to reduce the profit of parent company. How do we reduce it? So URP will be added to cost of goods sold. Simple. Now, whenever parent company profit is affecting, will it affect NCI? Nothing. Case 2, subsidiary selling to parent. So in this case, subsidiary is recording profit. If subsidiary is recording profit, that means NCI also will take a hit. So see here now. So what is the amount of transaction amount? Same case, reduce the consolidated revenue and cost of goods sold by transaction amount. Then, then what we do? So URP is recorded by subsidiary company. So subsidiary company profit is more. If subsidiary company profit is more, what we do? We reduce the subsidiaries profit. How do we reduce? By increasing the cost of goods sold. And this URP will be reduced from the subsidies profit after tax for NCI calculation, because the NCI profit will be low. These are the two cases which we have done. Now coming to intra-group sale of non-current asset in case of P&L. How will you do the adjustment? So case 1, subsidiary is parent is selling a non-current asset to subsidiary. If parent is selling, can I say parent company is recording more profit? If parent company is recording more profit, what should we do? Sir, we should reduce the profit of parent. How we will reduce? The URP will be added to the cost of goods sold to reduce the profit. Sir, now excess depreciation, which company will record? S company will record excess depreciation. The depreciation should be how much? 100. But how much is the depreciation they have recorded? The depreciation they have recorded is 150. That means 50 is the excess depreciation. So excess depreciation means subsidiary company has recorded more depreciation. More depreciation means profit is low. We have to increase the profit. So excess depreciation will be deducted from cost of goods sold. If you reduce the cost of goods sold, your profit will come up, which is recorded by subsidiary company. And then, sir, excess depreciation will be added to subsidies profit after tax for NCA calculation, because excess depreciation had reduced the subsidies profit. So we do what? We will add it back. So the profit will increase and the NCA will get the share. In case two, subsidiary selling to parent company. In that case, what will happen? See, Cost is there, sir, 1,000, sold for 1,500. So profit is recorded by subsidiary company. If the profit of the subsidiary company is more, we have to reduce the profit. How we will reduce? The URP will be added to cost of goods sold. Sir, subsidiary profit is taking a hit, NCA also will take a hit. So what we do? URP is reduced from the subsidiary's profit after tax for the calculation of NCA share of profit. Now, depreciation should be how much? 100. But depreciation is 150. So, which company is recording more depreciation? Parent company. So, if parent company is recording more depreciation, than what we do, sir? Excess depreciation will be deducted from cost of goods sold so that the profit of the parent company will increase. Here, there is no such NCA in case of depreciation because NCA had a take a hit regarding URP. So with this, I hope this is clear to everyone. The first again. Then coming to intra-group item, intra-group loan, parent to subsidiary. Parent company has given a loan to subsidiary company. In that case, what we do, even though you will not remove this, you will not eliminate the interest and expense, your penal answer will be right, but you have to do this. If you will not do, examiner will not give you full marks. Understand that. So what we do, reduce the interest income earned by parent company from the group investment income. Second, reduce the interest expense incurred by subsidiary company from the group finance cost. So one company will record an income, so we remove that. Another company will record a finance cost, we remove that. Subsidiary to parent, subsidiary company recorded as an income, parent record as an expense. So subsidiary company will remove the expense, straightforward, and remove the income, and parent company will remove the expense from financing category, from investment category. Understand? So this was the loan treatment. Dividend, sir, if parent company is the subsidiary company has given a dividend for parent company, then this will be included in investment income. So what we do, we normally reduce this from consolidated investment income, we remove this. Then coming to impairment. In case of impairment of goodwill, what will happen, sir? If it is proportionate method, the goodwill will only be allocated to parent. So how will you record this? How will you record this as an expense? Normally we record in operating category. Normally it is recorded in operating expenses, but unless specified, sometimes in the question they'll say that it is included in the cost of goods sold. So increase the cost of goods sold so that your profit will reduce. The next one, if it is fair value method, in case of fair value method, can I say NCA will also be affected? So the impairment you will take into consideration for calculation for NCA also. In that case, we have to adjust it. Now, sir, whenever there is a gain on bargain purchase, that means what? Any gain on bargain purchase is recognized in the operating category of profit and loss immediately, regardless of how NCA is measured. Regardless whether the NCA is measured proportionate or etc., the amount will be going to operating category. I hope this is clear to everyone. This will be allocated to parent only. This will never be allocated to NCI. Understand that. Sir, now deferred consideration, sir. Deferred consideration is an interest expense for which company? Parent company. So this will be recorded in financing category as an additional expense. So contingent consideration, sir. Increase or decrease in contingent consideration will either be profit or either it will be loss. So where should we record, sir? In operating category. In where? Operating category. Sir, any acquisition cost in P&L. In balance sheet we have seen retained earnings, but in P&L, operating category. Now, if the company is acquired between the reporting period, then what we do? Then consolidate statement of profit and loss should be time apportion. What do? You time apportion. You take each and every item. If revenue, sales, etc., you take revenue, income, expense, etc., 6 by 12, 6 by 12, you time apportion and take the value. With this, we have completed the revision of your P&L part also. With this, the P&L part is also done. I hope there is no doubts to anyone. Yes or no? If not, thumbs up. Now, chalo, starting with associate. Sir, associate. The standard which you apply is what? IAS 28. Okay, for goodwill, gain and bargain purchase will go to operating category. I did not mention. Okay, it will go to. I mentioned no, any gain on bargain purchase is recognized in operating category. If it is impairment, you take. See, when there is goodwill, then only there will be impairment. If there is gain on bargain purchase, then impairment will not be there. Impairment will not be there. So gain on bargain purchase will be recorded in operating category. It will not be allocated to NCA, only to parent only. Understand? Clear? Okay, very good. So associate now. Sir, what is associate? Associate means what, sir? We have 30 percentage, 35 percentage, etc. XYZ. So associate means what, sir? Associate means an entity over which investor has significant influence. So question mark. Significant influence means what? Significant influence means power to participate in the financing and operating policies of the company. When the policies are made, you can participate in that. You can't, you can advise them. You can't say that you have to follow this only. You can only advise. Where control or joint control is not there. Joint control means what? 50-50 percentage is there with the both the parties, and the consent of both the parties is required. Unanimous consent of both the parties is required. Then we say it's not an associate, it's a joint control, and that is not there in your syllabus. It's the part of the SBR. Then significant influence is assumed with a shareholding of 20 to 50 percentage, and significant influence is usually evidenced by one or more of the following. That means representation on the board of directors, and that representation should be what? Out of 10 directors, 3 directors you can appoint, or 3 directors belongs to you, or whatever you say they'll follow. It's a significant influence. Participation in policy making, yes. Material transaction between the investor and investee, yes. Interchange of managerial person you are changing, and provision of essential technical information, that some technical information you're providing in case of some technology companies, etc. In that case it becomes a significant influence. We had done an MCQ relating to this very important topic for MCQ, and the question will be straightforward in for MCQ in FR. It will not be too complicated. Understand that. So now, sir, accounting treatment, sir. How should we account, sir? Should we do consolidation? Will we add each and everything? No, Baba, no, no, no. That is not allowed. That is not allowed. IAS 28 says your life is simple when it's an associate. What should you do? A simple line item. Investment in associate in your balance sheet, in your PN, share of profit from associate. So see, equity method. Yes, sir. What does equity method say? Single line treatment. That is what in SOFP, investment in associate line with non-current asset, which includes the cost within non-current asset, which include the cost plus post-acquisition reserves. Once you acquire the associate, what is the post-acquisition reserves that belongs to you? So what do? You consider the percentage here. Each and every time you will consider the percentage, 30 percentage, 30%, 35, 45, which whatever is the data. In PNL, what we do? In PNL, we show a single line item, share of profit of associate, which includes the group share of any associate. So it will include what? It will include your OCI part also. If a associate company is there, once we acquire, they have a revaluation surplus. Out of the 30% or 25% will belong to you. Understand? So see here now, how do we calculate investment in associate? The first thing we take what? Investment in associate at cost. You take the value. Yes, sir. Add what? Post acquisition profits, whatever that belongs to associate, into percentage. Many students will do this mistake. They'll not consider the percentage. You have to consider the percentage. Then what's a less impairment of investment? If there is any impairment, you will reduce that also. If there is an impairment, you will reduce that also. Then what? Less dividend from associate. Whatever is the dividend, let's take associate paid a dividend of 1,000. Out of this, 30 has been given to you, so you will reduce it. Why are you reducing? The logic is what? The logic is that when you included post acquisition profits, you included the full amount. But now when once you get the dividend, can I say you're realizing it? You're realizing it. That means the amount which you have included above, you will reduce it because you've already taken that amount. Then less URP. Only URP. Which URP will consider? URP from parent to associate you will consider. Parent to associate, and whatever is the URP, again you have to multiply with percentage. Then less share of excess depreciation, whatever is the excess depreciation that belongs to associate in case of fair value of any asset. Then what should we do? Then we get what's an investment in associate in the consolidated financial position. So they see the journal entry, debit investment, credit cash or bank, cash is going on. Then what's a, can I say, post acquisition profit? What do? You increase the investment, and this will go to what? Sir, this will go to retain earnings in case of balance sheet. In case of PNL, it will go to share of profit of associate. Understand that. The next one, sir. In the next case, what we have, it's the case of impairment. If impairment is that, what will happen, sir? So the value of the investment will come down and the impairment will be recorded in P&L under which in which share of profit from associate. And if you're preparing balance sheet, it will be go to retained earnings, consolidated retained earnings. Understand? Then, sir, debit bank credit investment. That means you are receiving the dividend income. So bank is coming in, your investment value is decreasing. An important note that can come in your MCQ: cost of an investment in an associate may exceed the fair value of the associate net asset at the date. The difference is goodwill in the associate. However, this is never recognized as a separate asset in the consolidated financial position. The value which I'm getting in the associate and the amount which I'm paying will be more. So that difference is goodwill, but that goodwill will not be recorded separately. It is already taken care in the cost of the asset. Instead, goodwill is included in the cost of investment only. Understand that. Do not confuse with this. Then, sir, share of associate profit, how will you do? In your FR exam, what will happen? The question will be such a way that parent, subsidiary, associate data will be given most of the time. So what do you do? So parent and subsidiary company will consolidate. For associate, what do you? You show single line item. That is what? Share of profit. Share of associate profit after the operating profit. So see, share of associate profit. So how do we calculate? You take the associate profit after tax, you multiply with the percentage which you have. Then less amount of URP, in which case it is from associate to parent company. Then less impairment of investment associate, less share of excess depreciation. So you will get what? Share of associate profit in consolidated P&L. You will include this value. So this is the way how we do equity accounting. Now see here, intra-group trade. If parent is selling to associate, sir, if parent is selling to associate, which company is recording profit? Parent company is recording the profit. In that case, if parent company is recording the profit, that means it's the URP. So parent company recorded more profit. We have to reduce the parent's profit. How we will reduce the parent's profit? By increasing the cost of goods sold in the P&L. But sir, if it is retained earning, if it's your balance sheet, then we will reduce retained earnings there. And now, which company is recording inventory? Inventory is recorded by associate company. Do we include the inventory value of associate in the consolidated books? No. But how we will reduce? We will reduce the investment in associate. Investment in associate. But will you take the full URP amount? No, bet. You have to apply the percentage here. Do not do this mistake. Amount is equal to URP into the associate percentage. Second case, associate to parent. Associate is selling to parent company. In that case, what will happen? If associate is selling to parent, debit share of profit of associate, because associate company recorded more profit. So if associate company recorded more profit, then what we do? We reduce from the share of profit from associate immediately. Yes. But in balance sheet, what we do? In balance sheet, we reduce from group retained earnings, because understand, because if associate profit is more, can I say this associate profit will taken to group retained earning? Now parent group retained earning is more. Here you have reduced it. Here also you have to reduce it in the case of balance sheet. Then, sir, which company is recording the inventory? Parent company. Now, parent company inventory is available. So, we reduce the inventory of the parent company. So, what is the amount is equal to URP into the associate percentage. So, these are the two cases which are frequently tested in associate. Say, associate. Then, sir, see the step number 5. Normally, we have learned the step number 5 till here. After this, what we do? This one. Add parent share of associate profit. So you take associate profit into the percentage, you record it. And this, from this we will reduce the investment impairment of the associate. You will reduce the dividend part also. And then what we do? Oh, you will not reduce the dividend, you will only reduce the impairment. Dividend will be in the your investment in associate. And then less URP in both the cases, parent to associate or associate to parent. So you'll get your group retained earnings. Then step number 6, you will prepare investment in associate. So we have learned this. How do we calculate this? So with this, your associate accounting is done. Your IS 28, a very simple topic and an easy topic, frequently repeated in your exam. Now coming to the last topic of your consolidation, that is what's a disposal. Disposal means what? In your FR, disposal will be full disposal. It will not be partial disposal. Full disposal means today if you have 70%, fully you dispose. In your SBR, when you come, that is step disposal, step acquisition, a lot of things. So now in your FR, it's simple and straightforward. See, Whenever a company is there, if I say Reliance company, Geo company, Reliance company disposed of Geo, in that case, can I say gain or loss will be there? You have to record that only. If I dispose of a company, will I still do consolidation? No, I will not do consolidation. In balance sheet, we will never do consolidation. But in case of P&L, can I say till the day we have or till the date control is there, you will prepare consolidated books. So yes, enough. When a shareholding in a subsidiary is disposed of, it must be reflected in parents company individual financial statement. In individual books also we should record, and in group financial statement. That is the consolidated books. In the consolidated books. So see now, in parent company books, how will you calculate? Gain or loss on disposal, how will you calculate? You'll normally take the sale proceed. Whatever is the amount which you receive, less carrying amount of investment. Less what? Carrying amount of investment. How? What is the value of the investment? Did you use IFRS 9, fair value through P&L or fair value through OC, or you have recorded it at cost? You have to consider whatever is the carrying amount in your books. You will reduce this. If it's a positive number, it's a gain. If it's a negative number, it's a loss. So now, where should we record this in separate financial statements? In individual financial statements, it must be disclosed separately on the face of parents' profit and loss. Under which category? Investing category. It should be recorded as a separate line item. You should not take this into cost of goods sold. You should not take this into administrative expenses. You should record it separately so that the shareholders will get a true and fair presentation. Understand that? Then, sir, consolidated financial statement. What will happen to consolidated financial statement? See now, when this is what gain or loss in what parent book. In group, we will see full disposal, statement of profit and loss. 100% of the subsidiary result consolidate up to the date of disposal. Till the date of disposal, you consolidate as well as include what gain on loss on disposal. You should include what gain on loss on disposal also. You should include in P&L. So then, statement of financial position. What is this now? Statement of financial position. In statement financial, do you consolidate? No. At the year end, no shares are held by the parent and therefore disposed subsidiary is not included in the group statement of financial position. The gain or loss will be recorded where? The gain or loss will be recorded in retained earnings. In group retained earnings, the step number 5 which we do, or directly in retained earnings. So see now, what is the gain or loss on disposal? Important point. So we take the sale proceed? Yes, sir. Then less carrying amount at the date of disposal. What is the value which you have disposed of? So how do we calculate this? We take net asset at date of disposal, whatever is the net asset. Like we take no in the step number 2, your net asset on reporting date. Instead of reporting date, this will be what disposal date. Then, sir, net goodwill at disposal date. You will take the value of goodwill also at disposal date. Then you will reduce what from the? You will reduce NCI at the date of disposal, because this is 70 percentage. These both are what 100 percentage. We have to reduce the NCI part so that this also will be 70% and the comparison will be like with like. Understand? So see now, NC at the date of disposal, you will take this value, you reduce, you get gain or loss on disposal. Now this gain or loss on disposal in the consolidated books, how do you record? You record this in operating category. But in individual books, how do we record? In individual books, you record in investing category, because in individual book, it's what? A investment. But in consolidated book, it was a business. So you will record in operating category. Understand? So now what? How will you record? Journal entries what? Debit bank, debit bank is coming in. Yes, sir. Cash is coming in. Sir, goodwill we will remove. Net asset we will remove. NCA we will remove. And whatever is the balancing figure will be your gain or loss. Will be what? Will be your gain or loss. Understand that. Any doubt still here to anyone? Okay, no doubts. Then no such problem. Mm. Now, please see here an important point which we have to discuss. So, here now, presentation of disposed subsidiary. Once we dispose of a subsidiary, how do we record? Normally, we do line by line adjustment. We do 6 by 12, 6 by 12, 6 by 12. That is the traditional approach or the normal method to do. In that case, income and expense of subsidiary are consolidated up to the date of disposal. Profit and loss on disposal of the subsidiary is represented in operating category. Now, sometimes what will happen, the subsidiary will meet the definition of what? Discontinued operation. So, in that case, what should we? Should you do line by line adjustment? No, 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 no. Directly straightforward, you'll record gain or loss from discontinued operation. And the detailed calculation we will show in what? The detailed calculation will be shown in the notes to accounts. So, in detailed calculation, what will you do? You will take the revenue, cost of goods sold, expenses, finance cost, a lot of things of subsidiary and calculate the profit. So, discontinued operation. So see, discontinue operation. If subsidiary qualifies as a discontinue operation in accordance with IFRS 5, non-current as a held for sale and discontinue operation, results are aggregated into a single line on the face of the P&L. So presented immediately after the profit from the period from continuing operation as how, sir? Profit or loss from subsidiary up to the date of disposal, as well as profit or loss on disposal. Both the things will be adjusted and a single line, a single amount will be recorded. The detailed calculation will be shown in the notes to accounts. I hope everyone have understood this part. So with this, the disposal part is done. Now coming to some theory, which is very important for your MCQ part. So IFRS 3, IFRS accounting standard within FR syllabus relevant to the preparation of consolidated financial statements are given here. So IFRS 3, IFRS 10, IAS 28 and IAS 27. IAS 28, IAS 27. So see now, IFRS 10 outlines what? IFRS 10 outlines the definition of control. So what does control mean, sir? Control means power over the investee. Power to do what? Power over, power over relevant activities. Power over relevant activities. Activities. Then, sir, exposure or right to variable return from its involvement with the investee. That means as a company I have exposure or right towards variable return. That means whatever percentage I have, that percentage profit will belong to me. If the company is making loss, if the company is making profit, it will belong to me. Then, sir, the ability to use its power over the investee to affect the amount of the investor's return. That means as a parent company I will use this power to affect the returns of the subsidiary company. If they are doing some project, I will say that do not do this project. It will not be more, it will not be much profitable. Instead, do some other project which will be more profitable. No. I hope everyone understood. Now IFRS 10 states what? IFRS 10 states that how power will come. So power means what? So exercise of majority voting right. If you have majority voting right, we say power is there with you, control is there. Contractual arrangement between the investor and other members. If I say today I only have 40% shareholding, but one of my friend is there, he has 30% shareholding, that means I've done a contract with him saying that whatever I say you should follow. In that case, the 30% also belongs to me, control is there. Even though the percentage is less, even though the percentage is less, still I have control. Or if I say I have 40% shareholding, but the 60% is with a number of shareholders which are all over the world, and these shareholders cannot connect, and each shareholder does not have more than 2%. So the majority voting rights will be less in that case. So I only will be having majority as 40%. Then potential voting rights in future, if I have, if I have taken some convertible bonds or some share options in future, can I say my shareholding will increase? In that case also, it is an assumption that the control is there. Understood, everyone? I hope everyone have understood. Now, exemption from preparation of group financial statement. So IFRS 10 gives some exemptions, saying that a company need not prepare its consolidated books when all the criteria are being met. Four conditions are that it should be met. So what are the conditions here? A parent company is the parent company has subsidiary, and this subsidiary will have a subsidiary. So this is one. So can I say this company will become a parent company for this subsidiary? For this subsidiary. Now what should you do? See here now. A parent company need not present consolidated financial statement if and only if parent is a wholly owned or partially owned subsidiary with the non-controlling the NCA consent. That means this, can I say here, this parent company is a wholly owned by someone. Can I say parent companies, this parent company is wholly owned or partially owned, and this parent company, this subsidiary company will have NCA also. Can I say the NCA are there? So this NCA should give a consent saying that okay, no need to prepare consolidated financial statement. When, see now, parent is a wholly owned or partially owned subsidiary, then, sir, parent debt or equity instruments are not rated. That means the subsidiary which is there, no, this S1, the S1 should not be listed on the stock market, or it should not be in the process to be listed. Next one, parent is not in the process of issuing securities in the public stock market. The ultimate or intermediate parent presents consolidated financial statement in accordance with IFRS accounting standards, considering all the subsidiaries. That means, can I say this parent has an ultimate parent, that is P. This parent company is preparing consolidated books as per IAS and IFRS, and it should prepare the consolidated books of these three companies. Then we say that this company need not prepare consolidated financial statements. I hope everyone have understood this. This also can come in your MCQ. Then some important notes. Parent company may not wish to consolidate some subsidiary. This will happen when, see here now, a parent company, that this parent company has a subsidiary. The parent company is into manufacturing industry. This subsidiary is into edtech business. Now parent company will say what? We will not consolidate this because our business is totally different. The subsidiary business is totally different. So these are the reasons which a parent company will give to avoid consolidation. Or the parent company will say that the company is in losses, so we will not consolidate. If we consolidate, the consolidated books will not look good. So they are doing manipulation. But IFRS 10 says what? IFRS 10 says there are no exclusion from consolidation of individual subsidiaries that meet the control criteria. If control is there, whatever, whether the company is good, bad, it's operating in some other country, whether it's operating in India, some other business loss making, you have to do consolidation. Understand that? Now see IAS 27. IAS 27 what? Separate financial statements. Now I explained you what is separate financial statement. This is Reliance company, Geo company. Reliance company will prepare its books. This is individual financial statement, individual financial statement. Now Reliance company will purchase Geo company 70%. In that case, Reliance company will prepare, Geo company will prepare. Now Reliance company will do what? Reliance company will record in this balance sheet P&L as what? In the balance sheet, investment in Geo. This will become what? Separate financial statement. All the standards will be followed normally. But what is the additional standard we follow? IAS 27. Then the Reliance company will prepare consolidated financial statement to show power in the market or to do show off in the market. Simple thing. So when this, now we are learning the IAS 27 for this. In the individual books, how will the company record? Now, in the individual books, the company can record it at cost, whatever is the amount you paid, or the company can record as per IFRS 9 financial instrument using equity method as per IAS 28 or in accordance with IFRS 9. IFRS 9 means two methods, fair value through P&L, fair value through OCI. Understand? Then uniform accounting policy, that means what, sir? The accounting policy of both the companies should be same. If one company is following cost model, the other company is following revaluation model, it becomes difficult. So subsidiary companies should prepare its balance sheet and P&L again, saying that the accounting policies are same, so that the consolidation will be done smoothly. There will be no such issues. I hope everyone have understood this. Then non-coterminous year. That means what? The financial year or the reporting period for parent company is different and for subsidiary company is different. In that case, I say parent company prepares balance sheet for 31st Jan, but subsidiary company is preparing from 1st April. 1st April. So it creates an issue. So that is a 3-month difference. So see now, what does the standard say? IFRS 10 allows use of subsidiaries financial statement made up to date of not more than 3 months. Okay, if the time period is not more than 3 months, you can use this. If the time period is not more than 3 months, you can, no issues. 3 months or 3 months earlier or later than the parent's reporting date with due adjustment for significant transaction or other events between the dates. So whenever the difference is for 3 months, what will you do? You will do the adjustment for significant transactions. If more than 3 months, then financial statements of subsidiaries should be prepared as on the reporting date of the parent company. So if the difference is 3 months or less than 3 months, then when you do consolidation, please include the significant transaction. Avoid small transactions. And if it is more than 3 months, then what should we do? We should only include the 7 months or 6 months profits of the subsidiary company. So with this, we have completed the revision of your consolidation. Each and every point I've mentioned. So understand, whenever a consolidation question comes in your exam, it will be damn easy. 15 to 16 marks will be easy. The 4 marks also will be easy. But what will you do? You will be in a pressure. Simple. See, whenever you write any exam, the question paper which you get for the 3 hours, the exam, you'll feel that the exam is very tough. But the same question paper, if you're outside the exam hall, I just say you that okay, write down this as a mock or just a simple thing. If I give for calculation, you'll do easily. So whenever a question paper in the exam hall, the question paper will be tough. The same question paper, if I give after the exam hall, that means you're not in the state of writing the exam just for normal calculation, then you will say okay, so the paper was very easy one, we had done small silly mistakes. So it's important that you stay calm and avoid silly mistake and read the question carefully. See, in FR as mentioned, section A, section B, 10 questions will be straightforward. Avoid silly mistake in that. Read the question carefully. And in your section B, 40 marks, 32 marks will be easy. 32 marks will be easy. So if you have written your mocks also, as many students will say me this, so we have written mocks, we are scoring 45, 50. Why? You sit and write down mock in a piece. There will be no stress, nothing. You'll simply, okay, I have to write mock, okay, I'll do it. But the same mock, if you write with pressure, you'll do silly mistakes. So it is important that you be calm in the exam. Easy questions will be there. The question paper will be easy only. You are writing the paper for the first time. Now, if I say that you have to set a paper for class 3, you will do what? Out of 100 marks, you will give 70 marks easy only. 10, 30 marks also will be easy only, but you will twist it little bit. If you see in your FR also, the theory question will be twisted. You have to read it properly and eliminate it. Eliminate the sentence. Out of 4, 2 will be wrong only. You can identify. Out remaining 2, read it again and think and tick the answer. So let's this with this consolidation is done. So each and every point I've mentioned. Now I will do IAS 7. Statement of cash flow. Sir, is this very important? Yes, very important for section A. And section C also, the examiner has already mentioned that a full question of cash flow will not come. A full cash flow question will not come. So see, statement of cash flow. Definition. What does cash flow mean, sir? Inflow and outflow of cash and cash equivalent. So the question comes, why do we prepare cash flow? Cash flow is prepared so that we get to know the liquidity position of the company. How much cash is that? The company will earn 10 million profits, but when we see in the bank account, the cash is only $100,000. That means the company is not able to manage its cash properly. The company could face severe problems in future. So cash flow means what? Inflow and outflow of cash and cash equivalent. Sir, we know cash. What is cash equivalent? Cash equivalent also means cash only. Now see, what is cash equivalent? For theory question important. So cash equivalent means what's a short term, highly liquid investments that are. So cash equivalent means what? It's a short term. That means if I do a fixed deposit in a bank for 3 months, it's a short term and it should be highly liquid investment. Easily I'll get it back. And I know what is the amount I will get back. If I go today to the bank, if I've done a deposit, I know what is the amount I'll get back. The bank will cut some charges saying that you are taking the amount before only, and subject to an insignificant risk of change in value. The value should not change significantly. The value should not change significantly. I hope everyone have understood this point. So note, equity investments are excluded from cash equivalent if they meet these two conditions, three conditions. You can say cash equivalent, but 99.99999 percentage equity instrument will not be cash equivalent. Understand that? Then, sir, bank borrowing. Whenever you take a loan, where do we include this? We include this in financing activity. But your bank overdraft will be part of cash and cash equivalent. So under cash flow, what are the three activities we have? Operating, investing, and financing activities. Sir, operating activities means what? Operating activities means the inflow and outflow from your main business activity. That should not be included in investing or financing. Sir, investing means what then? Investing means inflow and outflow from purchase or sale of long-term assets, and that long-term assets should not include cash equivalent, because cash equivalent means cash, and cash is not included in investing activities. It will be included below when you do the total. Then financing activity. Financing activity means what? Financing activity means the change in the equity part or non-current liability, whether you have taken some additional funds or you have raised finance, etc. So this change in the size of equity capital and borrowings. So now in operating category you have two methods, direct and indirect method. For your investing, you have direct method. For financing activity, you have direct method. Understand? Now, sir, what is direct and indirect? Direct method means what? Cash inflow minus outflow. Whatever is the inflow minus I do outflow. That is direct method. Indirect method means what? It's complicated. It's not complicated. It's common sense. So adjustment to operating profit. You normally take the operating profit and you do the adjustment. What adjustment you do? If in operating profit any non-cash item is added, you will reduce. If non-cash expenses done, you will add it back, all these adjustments. So in your FR, indirect method only will be tested, direct method in your FA. So see now, what is the cash flow format? The format for cash flow is this one. Cash flow from operating activities, you write down this. Cash flow from investing activities. So cash flow from financing activity. Increase or decrease in cash and cash equivalent, you will get what during the year, what was the movement, either outflow is more or either inflow is more. Then what do? You take the opening balance. This opening balance will be given in your balance sheet. Take it and do the adjustment. Do these two totals. You'll get some number. This number should tally with your closing balance in your balance sheet. If it tallies, your answer is right. If not, here and there, some mistake is there. And I'm mentioning here in FR, examiner will never ask the full format. Either they'll ask you investing category, financing category, or operating category. This time, chances are very high that the question comes from operating. Why? For 3 to 4 months. Because the format of the cash flow has been changed, as mentioned to you. So now cash flow from operating activity. See now, sir, indirect method. So we take operating profit. First, it was what? First, we were taking profit before tax. Now we are taking operating profit. So then you do the adjustment. Sir, what are the adjustments? See, depreciation, amortization, impairment, you will add it back. Because these are non-cash expense. It's not actually reducing your cash balance. We'll add it. Then, sir, add or less profit on sale of PP. Okay. Profit and loss, we have to do the adjustment here. Why? Because whenever you sell any PPE, if I say today the value of a asset is 1000 and you're selling this for 2000, that means 1000 rupees profit is that you normally record in the operating profit. But now I say an important thing here. You will remove this profit from here. Why? Because this 2000 will be included in the investing category. It will be included in the investing activity directly, the 2000. So you remove the profit or loss because the impact is taken where the impact is directly taken in investing activity. So see now, if a profit is there, you will less it. If loss is there, you will add it because the impact will be taken in investing activity. Whatever is the amount which you receive, disposal proceed, it will be an inflow in investing activity. So less investment income. Sir, why do we less your investment income? If by chance in the question they have mentioned that they have included in operating category, you have to reduce it. But I have not seen such question coming. If it comes by chance, if they say some item has been included in operating which had to be included in investing, so remove it. Then increase in provision. If there is an increase in provision during the year, you will add it because provision is an expense in your P&L under operating category. But is this a cash outflow? It's not a cash outflow actually. So whatever is the increase in provision, you add it. Then less government grant amortize. Whatever is the amount government grant, your IAS 20, every year you record amount in P&L as an income, that you will reduce it. Why? Because this will be taken care in investing activity. These are the adjustments. Then, sir, adjustment for change in working capital. So, what? How do we calculate this? The closing balance and opening balance sheet will be given. Closing and opening. So, compare the amount. You will get the previous year closing and this year closing. Compare. If I say increase in inventory, you will reduce it. Why? If your inventory is increasing, the assumption is what? We pay the cash and purchase it. So, cash will reduce. So decrease in inventory. If my inventory is decreasing, that means we are selling it. If we are selling, cash will come up in, so we add it. Sir, increase in receivables. Sir, my receivables are increasing. That means I'm not receiving the payment. I'm doing more credit sales. So that means I will reduce the amount here. Sir, decrease in receivable. If my receivable is decreasing, that means I'm receiving the amount. We will add it. Sir, increase in payable. Sir, my payable is increasing. That means payable will increase when? Payable will increase when you pay late. You are not paying right now. That means your cash balance will be more. So decrease in payable means you will reduce because the amount is reduced here. So then you will get what? Cash from operating activities before income tax. So before income tax, you get the cash flow. Less what do you do? Less tax paid. What is the tax paid? The net amount. In the previous format, we used to write down here interest paid also. We used to add here and again used to reduce here. But now interest paid will be taken care in financing category. Then you get net cash flow from operating activities. So now, sir, note an important note, the crux of this calculation above water. If it is a non-cash expense or losses, simply add it. If it's a non-cash income or gain, simply reduce it. Then, sir, increase in operating liability or decrease in operating asset, you will add it. That means my operating is increasing, my decrease in operating asset. So we do add. Sir, increase in operating asset and decrease in operating liability, we reduce it. I have given the explanation and the logic for this working capital changes. So with this, your operating part is done. Now, cash flow from investing activities. So we do what now? Cash flow from investing activities. Now, how should we do the adjustments here now? So in investing category, investing activity means what? Investing activity basically means what? Inflow and outflow from the purchase or sale of long-term assets, some dividend you have received, government grant, then your interest received, etc. See, purchase of property, plant, and equipment, it's an outflow. Purchase of intangible asset is an outflow. If you dispose of any non-current asset, can I say we get proceed, we added. So that is the reason we remove here. We remove the profit here and the loss, the profit and loss impact will be removed from the operating part. And because why? The impact is already, the impact will be considered in the investing activity. Then, sir, government grant received. Yes, sir. Then proceed from sale of long-term investment. You will add it. Interest received, you'll add it. Dividend received, you'll add it. Loan, cash loan to third party. You have given a loan to some third party. You will reduce it, and it's not your main business. Understand that. Net cash flow from investing activity will get. Then you have cash flow from financing activity. Sir, in financing activity means how much is the fund we have raised, how much is the repayment of loan, etc. So proceed from share capital during the year. If the company has issued some share capital, they'll get the amount. What is that amount? Add it. So proceed from long-term borrowing. The company is issuing some bond. What is the cash that is coming in? Then the repayment of long-term borrowing. If you repay, can I say cash will be going out? You will reduce it. Then what? Sir, payment of lease liability. When you do the payment of lease liability, that means what? You will reduce it. I hope this is clear to everyone. Then dividend paid. If dividend is paid, we reduce. Now how will the company get to know that the dividend is paid? The company will get to know that the dividend is paid when they prepare the ledger account, T account of retained earnings. Then interest paid, you will reduce. You get what? Net cash flow from financing activity. You take all these values, you will take all these values, you will take and do what? You will take this and this, you get during the year whether that is an increase or decrease. Then what do, whatever is the opening balance, how will you get the opening balance? Previous year balance sheet, in that you will have the value, take it, you will get the closing value. Now check this closing value is equal to the this year closing balance. If it's equal, your answer is right, and mention the full format will not be tested. That is the reason I've written in parts here. The format when you see for the cash flow, it is a full one. So with this is done. Now see, I have made some ledger accounts, your T accounts here, so that this are very important. You have to do this. Adjustments will be from this only. 99% I've seen that adjustments are repeated only. So now tax paid, sir. How should we calculate the tax paid, sir? You prepare the account. Hmm. Then here, whatever is the opening balance, deferred tax, current tax, deferred tax, current tax, you write down. Then during the year, can I say there will be income tax charge as per IAS 12? Current tax will be there, deferred tax also will be there. You have to do it. And can I say on revaluation gain also deferred tax will be there. You will add it expense. Then whatever is the balancing figure on the debit side will be your tax paid. will be your tax paid. If I say the balance is here, here the balance is 100. Here it is, the balance here it is coming to 120. That means during the year we have paid here 20. We have paid the 20 year tax paid. Then coming to PP, sir. In case of PP, what do we do? We record opening balance. Yes, sir. We record closing balance. Then what we do? During the years, a revaluation. Revaluation will increase the value of PP. You add it. Depreciation will reduce the value of asset. Disposal also will reduce the value. You will remove these. Then any right to use asset is that during the year you will include. Then I say here the balance is 140. Here the balance is 100 only. That means during the year 40 was the additional purchase during the year. So you'll consider this point. So whatever the balancing thing will be, what that means, the company has purchased asset during the years. I hope there is no doubt in this. Then government grant. So government grant, can I say government grant is recorded in the P&L as a liability? So it will have a credit balance. Balance brought forward, carry forward. And during the year, when you credit it, can I say we reduce the government grant? And whatever is the difference on the credit side will be the grant received. Where will you take this grant received? To investing category, investing activity. Let me say activity, because category we use in IFRS 18. Then sir, share capital and share premium. So you make both the accounts together only, so that there is no such problem. So you record the opening balance of share capital, share premium, share capital, share premium. Can I say if during the year bonus is given, bonus will do what? Increase the share capital but reduce the share premium. Yesterday we have discussed that share premium bonus is given from share premium. Then whatever is the difference on the credit side will be what, sir? Whatever is the difference on the credit side will be new proceeds which are issued by the company. So this will take a hit where financing activity. You will add it, saying that it's an inflow for you. Then for retained earnings, why do we do for retained earnings? To know how much is the dividend paid. So you record this debit credit, you take the opening balance, you take the closing balance, and during the year retained earnings will increase because of what? Profit. And on the debit side, whatever is the balance will be the dividend paid. Then lease liability, sir. In lease liability, what do? You prepare the lease account, current, non-current, opening balance, closing also. And during the year, if there is any new lease, you will add it. And on the debit side, there will be a lease payment. Most of the time for lease payment, they'll directly mention in the question for dividend lease payment. If it is not mentioned, please do the T account, your ledger account, and calculate the value. Any doubts in this to anyone? Cash flow? Why better? Pavitra. Sir, F7, sir, is your sir, in financial reporting, many students will leave cash flow. But if I say in MCQ question, okay, no doubts. Okay, then no issue. So with this, the cash flow part is done. I hope there is no doubts. So what will I do now? I will do a small standard, then we'll take a break. IFRS 13 I will do, which is not so important. After that, we'll do IS 37, IS 8, and IS 10. So now I'll do IFRS 13. So see now, IFRS 13. So what is IFRS 13, sir? IFRS 13 is fair value. Very important for MCQ, not other. If it's a very bad day, you can have a MCQ question from this. If not, you're lucky. IFRS 13, sir, fair value. So what does fair value mean, sir? In We have seen a lot of standards where we use the concept of fair value, intangible asset, PPE, IS 40. Then we have seen in IS 36, IFRS 5, then your leases, then your financial instrument, revenue. So now all these standards use the concept of fair value. Now, first, when the standard was not introduced, the standard was not there. Each and every standard used to define how to calculate fair value. But now it was too complex to remember for each standard. So what the IASB has done, they have introduced a fair value, a standard. This standard will only teach you what? This standard will only teach you the calculation of fair value. Where should the fair value be used? How it should be used? Everything in other standard. Like in your IS 33 also. IS 33 only it will teach the calculation of EPS, no accounting. Same way, IFRS 13, fair value. Now what is fair value? Now fair value will not apply to CNM. In inventory, we'll never apply fair value concept because NRV is entity specific, fair value is market specific. IS 36 impairment in value news will not apply. Share based payment that is not there for you, and for IFRS 16 leases it will not apply. You have to remember these 2 points for value news and inventory for MCQ calculate. MCQ. So what is the definition? What is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability. It is exit price, it is not entry price. Fair value is exit price, it's not an entry price. Understand? So what is the amount if I sell today this asset in the market? What is the amount I will get in an orderly transaction? Orderly transaction means the transaction should be at arm's length. It should not be a forced sale. Someone should not sell an asset under pressure. If they sell under pressure, that means they will keep the value low only because they are in need of money. That will not be a fair value. Understand that? Between market participants, that means between parties, and that party should have good knowledge. It's not that you have no idea regarding iPhone and I'm selling you a second hand iPhone for 2 lakh rupees. It's not fair value, it's not correct. Then at measurement day, the date on which you want to calculate the fair value. So I hope everyone have understood this fair value definition. So when determining fair value, entity specific restriction important for MCQ. Entity specific restriction should not be considered, but asset specific restriction should be considered. That means today I have a car. I see this car, I will only use for my personal use. But if I give this car on taxi or rent it out, the value will be more. So as per market terms, can I say I can use this car however I want? So in that case, when you calculate the fair value, you should consider from the market point of view. You should not say that, sir, I have the restriction. My entity is saying that I am saying that I will not use. So in that case, entity specific restriction should not be considered. Asset specific restriction should not be fair. Entity specific restriction should not be considered. Asset specific restriction should be considered. If sometimes the government will say that, okay, if you have purchased this car, you can't give this on rent, etc. Can I say this will apply to overall market also? It will apply to each and every person in the market. Understand? Fair value measurement assumes that the transaction to sell the asset or transfer the liability take place either. So there are the concept of principal market and most advantageous market. If in India, if I want to calculate, I have invested in Reliance shares. I want to calculate the Reliance fair value. So what will I do? I will normally go to the stock market. Now in stock market, BSE or NSE, there are two markets. Confusion will be there. So now which market should I refer, sir? You should refer principal market. Principal market means where the asset and the liabilities are traded in high volume. So most of the time in India, it's NSE. So I'll refer the NSE share price. Even though BSE, in BSE, Bombay Stock Exchange, the value will be more. In NSE, the value will be less. I will not consider the value which is more. I will see the volume of transaction here, the frequency of transaction. Understand? So what is the fair value formula? Price of the asset or liability minus transportation cost. Minus transportation cost. Sir, if the markets are similar, it's a confusion on both the mm, stock market. On both the markets, the number of volume is same, once year, once year. In that case, a confusion will be there. Then comes the concept of most advantageous market. What will you do? Now you will see the market which will provide you the maximum benefit. The maximum benefit. So now, when you want to calculate the fair value in case of most advantageous market, two steps. Step one, step two. Step one is what? Identify most advantageous market. There are three markets. First, identify where will you get the highest benefit. After that, calculate the fair value. To identify which market will provide highest benefit, you have to do step one. So that is price of the asset or liability less transportation cost and transaction cost. You will get the net amount which you receive. To calculate fair value, we only consider transportation cost. But to calculate which market will provide you more benefit, you consider transaction cost also. Then out of A, B, and C I have done, this B is providing me most benefit. Then what we will do? Then we calculate the fair value. When you calculate fair value, price of the asset or liability less transportation cost. You will not consider transaction cost. Why? See, transaction cost is entity specific, but fair value works on the concept of market specific. Understand that? I hope this is clear to everyone. Now, determining price of the asset or liability for fair value measurement, the fair value hierarchy. Now, when you calculate the value, fair value, you take some data. No? That data should be based on market. It should be what? Market data. It should not be your own data. I estimate, I assume that will happen, this will happen. No. What is the data which is available in market? Use that so that the true value will be calculated. So see now, level one, observable inputs. That means the observable inputs normally used by the market participant. So that means quoted price of identical assets or liabilities in an active market. Example is for what's a level one, Reliance share price. Level two, what's a, sir, if there is If the stock is not listed, then what we do, sir? If the stock is not listed, what will you do? You'll estimate, you'll assume. That estimate or assumption also should be based on market. See, observable inputs, quoted price for similar or asset or liability, quoted price for identical assets in a less active market. Observable inputs like interest rate. Basic means what? If today I say a company is there, that company is not listed. If it's not listed, will you apply level 1? No, sir. Then if level 1 is not applied, go to level 2. So level 2 means what? So the price is not quoted, but can I say a similar company is there in the market? My competitor is there. My competitor is listed. I will take the share price and I will do some adjustment. I'll use my calculator. I do some adjustment. That is level 2. I have taken the market data, but I've done here and there some adjustment. The best example could be what? For your property. This is a land. There are one, two, three properties. Four properties. One, two, three, four, five, six, seven, eight. Now you are using IAS 40. You are using fair value model. Now this property belongs to you. This property belongs to you. Now you want the fair value. What will you do? You'll call a broker nearby your area. You'll ask me. You'll ask him. Okay, whether any one of this plot has been sold. The broker will say that plot number two, sir, has been sold 5 days before only. So he'll say this was sold for 10 lakh rupees. This was sold for 10 lakh rupees. But now say me, is this plot 2 and plot 5 same? No, the plot 2 and plot 5 are different because this is a corner side. It's on the corner. Both the side road is there. Here only one side. That means the value of this plot 5 will be more. So the person will take this 10 lakh rupees and he'll say, okay, 2 lakh rupees. Someone will pay me more because it's a corner side. So this is what level 2. You're using market data only, but you're doing some adjustments here. Then sir, level 3. Level 3 means no data available. You do your estimate only. How do you do your estimate? You consider what will be my future cash flow, my future income. You discount and calculate like your value in use. So unobservable inputs, price based on assumptions and forecast of entity, less reliable compared to level 1 and level 2. So present value of forecast, future cash flows, no market data, minimizes unobservable inputs. So the aim should be what? To use a lot of market data. So to get the true value. So this was the input to calculate the fair value. What are the inputs you have to take? Then coming to the next concept, non-financial asset. Your non-financial assets are like your PPE, your land, your machine, etc., car, a lot of things. So in case of non-financial asset, specific guidance is given. How should you calculate the fair value? While determining the fair value of non-financial asset, entity should consider highest and best use of asset. That means highest and best use should be considered. If I say today I have a piece of land. This land is a non-financial asset. Now this is my I have constructed a house. It's a residential. I have constructed a house. I'm using this for my residential purpose. Now to calculate the fair value, even though you're using for residential purpose, but can I say this land can be used for a lot of things like commercial property? It can become. Can I say here agriculture we can do? Can I see a mall I can construct here? I can see a stadium. A lot of things you can do. Now when you want to fair value, when you want to consider the fair value, you have to consider the market perspective. Even though it's your house here, it's a commercial area, a school can also be developed, a commercial property or a mall, etc. In that case, which one will provide you the maximum benefit? That fair value should be considered. Even though you are not considering, you have to consider that. So see, highest and best use takes into account the use of the asset. That is physically possible. It should be physically possible. That means you should be able to construct it. You should have money also. It should be financially feasible. Then it should be legally permissible. Legally permissible means you should know, okay, this is what, sir? I have a land today. Now you know this land is in a good area where government will allow either to construct a mall, commercial property, etc. Then no issues. Even though you do not have a approval from the government, but you know normally the government will give the approval. It's legally permissible. It's not legally permitted as of now. So if I say this residential property, government will pass an order saying that you can't construct here commercial property. Then will you consider this one? No. You will remove this one. You will remove this one. Then only you have two options. Government will say that you can't construct a stadium. Then either you can use your for residential or you can grow some vegetable in this. So all the three conditions should be satisfied. Then we say highest and best use. Which one will give you the more value? That will be the fair value. Then sir, what are the three types of valuation technique? Market approach, cost approach, income approach. Income approach we have used like value in use calculation. Market approach means whatever is the as per market, like a fair value. Cost approach means what? Cost approach means replacement cost. We have covered in the first day revision IS2 replacement cost. Understand? If today I want to purchase the asset with the same condition and same usage, what is the cost of that? So with this, your fair value is completed. Questions I'm not seeing for theory question. If it's your very bad day, I say you can have a question from this topic. Any doubts in the fair value to anyone? No doubts. Okay. Now IS 8, IS 37, IS 10 is pending. So let us take a small break and come back and do the three small standards. It will not take more than 30 minutes to come. So the time is now 7:58. Everyone be back by 8:10. Take a break and be back by 8:10. Chalo, chalo, chalo. Come back, everyone. Single entity, no better. Single entity revision. It's about IS and IFRS only. The aim, as mentioned, the marathon sessions will focus on the IS and IFRS revision and the mistakes which you make. Others, yes or no in the chat box. Chalo, chalo, chalo. Let us start now. IS 8, a very important topic for part 3, important topic for your MCQ as mentioned. So now IS 8. First, the name of the IS 8, what's the name of the IS is 8 has been changed, but the content is same only. The name is IS 8 is what basis of preparation of financial statement. First, it was accounting policy, estimates, and prior period error. Everything is same, but the name of the standard has been changed.
Not audible, so
Hello, hello, hello. Yeah, I'm audible now, I hope.
yes.
Yes, chalo, chalo, chalo. IS 8 provide guidance on 3 general matters, and these are the thing. Fair presentation you normally cover in what your conceptual framework, that it should be free from bias, the financial statement should be truly presented, etc. To ensure fair presentation, entity should ensure what the recognition measurement criteria are being met as per the respective standards. Then present information in a way that ensures it is relevant, reliable, and comparable and easy to understand. Give additional disclosures when IFRS requirement alone do not fully explain how a transaction affects the financial position or performance. You have to give the disclosure, you have to follow the accounting policy, recognition criteria, measurement, it should be relevant, it should be material, all these are the points. Then compliance with IFRS accounting standards. So what does this means? If the company is following IS and IFRS, they should mention saying that we are fully following the IS and IFRS. It should not be that the company is following 60% of the IS and IFRS and 40% some local gaps. If they are following IS and IFRS, they should make a statement. The statement should mention that we fully comply with IS and IFRS. Then going concern. Going concern means what? The business will continue for the foreseeable future. And if the business is unable to continue in the foreseeable future, then what we do? We prepare the balance sheet and P&L on the liquidation basis. On the liquidation basis. If the company is not a going concern, financial statements are prepared on a breakup or liquidation basis. No IFRS accounting standard provides guidance on this basis, and management should choose accounting policy that results in the most relevant and reliable information. Any IS and IFRS will not provide, but they should do what? They should provide. They should choose the accounting policy which best suits the company, which is best for the company. Understand? Accrual basis means the company should record the income, expense, asset, and liability should be recorded as per when the definition of conceptual framework is met, as well as can I say they should be recorded when they are incurred rather than when the payment is done. Understand that? accrual basis, everyone know. That means we are not doing on cash basis. As and when it is incurred, we have to record it. Now coming to the concept of accounting policy. So what does accounting policy mean, sir? Accounting policy are the specific principles, basis, convention, rules, and practices applied by the entity for the preparation of financial statement. It provides the basic principles, some rules and regulation for the preparation of financial statement. So what are the examples of accounting policy? The examples for accounting policy are what? LIFO, weighted average cost, FIFO, the measurement principle, cost or revaluation model, then accounting accrual or cash basis. In your government grant, we follow two methods. One, we reduce it from the cost of the asset, and the second one is what we record it as a deferred income. Then these are the examples for accounting policy. Now, selection and application of accounting policy. How should the company select an accounting policy? Selection and application of accounting policy. See, when specific IAS and IFRS is available, then follow that. If any IAS and IFRS is saying that you have to follow this, follow. No issues in that. So follow that IAS and IFRS and apply the policy as per the guidance provided in IAS and IFRS. When specific IAS and IFRS is not available, then what will the company do? These are very important for theory question section A. When IAS and IFRS is not available, then what will happen? Management shall use its judgment in developing and applying accounting policy. So management should use what? Judgment in applying the accounting policy. So now when the management is using the judgment should be based what? The judgment should be relevant and reliable. Management must use its judgment in developing and applying the accounting policy, and the information should provide, then information which is provided should be relevant and reliable. Relevant means it should affect the decisions of the users, stakeholders. Reliable means what? It should be free. There should be no biasness, neutral, prudence concept you have to follow. All this. Now, sir, when management is applying the judgment, management will consider what? The management will consider what? Management will consider, if the management, if there is no accounting policy, they do judgment. And when they do judgment, the information which they use should be should be relevant and reliable. In that case, if the management will see whether there is any similar transaction. Normally, if a grant is given by the government, we follow IS 20. If I say a grant is given by some third party, so how will you account it? You will use the similar transaction which is mentioned in IS and IFRS. Like IS 20, follow the same accounting policy, deferred income one. Then the next one, definition and recognition criteria of conceptual framework. If there is no similar, if there is no similar transaction, then what will the entity do? The entity will consider the recognition criteria as mentioned by conceptual framework. If no similar transaction, then the company will use conceptual framework, whether asset, liability, income, or it should be recorded over the period or at point in time, etc. If conceptual framework also is not applying, then the company or the management should see whether this accounting treatment is mentioned in any other accounting standard like US GAAP accounting standards, other standard. You have to, the management will see whether any other standard setting body defines the transaction or they have given the accounting treatment, they should use that. If that is also not available, then what? Whatever is the industry practice, you have to follow that. This is the way the management should consider. Then coming to the next important point, look, consistency of accounting policy. That means whenever we apply any accounting policy, it should be applied on a consistency basis. Here means what? Why should the accounting policy should be applied on a consistent basis? Why? It is important so that the shareholders can compare the financial position, financial statements. They can compare. If 1 year we are following cost model, the second year we are following revaluation, then cost revaluation, it becomes difficult for the stakeholders to compare the financial statements. Changes in accounting policy. Sir, can we change the accounting policy? But sir, just now you mentioned that the accounting policy which we apply should be in a consistent way. Then can we change it? Yes, we can change. When? If it is required by IS and IFRS. If the IS and IFRS is saying, do change it. So this will be what? A mandatory change. If IS and IFRS is not mentioning, still the company can change the accounting policy. When? If it provides more relevant and reliable information. This will be what? Voluntary change. I hope everyone understood this point. Excuse me. So with this, we have covered the basic theory. Now, chalo, next point. Following are not considered as a change in accounting policy. So these are the two things which are not considered as a change in accounting policy. This can come for your MCQ. So now see here now. The application of an accounting policy for transaction or other event or condition that differ in substance from those previously occurring. So normally means what? We have studied now in IS 40, PP to IP, investment property, or IP to PP. In that case, I say PP is at cost model and IP is at revaluation model. Will this be considered as a change in accounting policy? No, this is the change. It is a change in the use of the asset. So see, reclassification of PP, revaluation model to investment property. This is not considered a change in accounting policy. It's a change in the use of the asset. The next one, the application of new accounting policy for transactions, other events or conditions that did not occur previously or were immaterial. That means normally the company has done a transaction, but the transaction is not material, it's of low value. Let's take it is of 10 rupees, and Reliance will say that we will not record this transaction. So but now in future, this item which they have purchased for 10 rupees, now this value becomes 1 lakh in the market. Some magic. So in that case, they have to record this. Will this be considered as a change in accounting policy? No. And if you're recording the asset for the first time at cost, will this be a change in accounting policy? No. This is the first time when you're recording. Previously, you did not recognize because the transaction was immaterial. Now it's material, so we record it. So these two things will not be considered as a change in accounting policy. Excuse me. Then, excuse me, accounting for a change in accounting policy. So, how should we do, sir, if there is a change in accounting policy? What will be the accounting treatment? See, change in accounting policy resulting from the application of an IS and IFRS. That IS and IFRS itself provides specific transitional provision. Follow them. That means what? Your IFRS 16, your IFRS 15 are the new standards. We had account old IS relating to the revenue and leases. So now when there was a shift from the old standard as per lease and the new standard, that when the new standard your IFRS 16 came into picture, in that case transitional provisions were provided. That means how should the accounting treatment be done? If you're shifting from the IAS, which was for lease, and now you're shifting to IFRS. In that case, they have already provided this IFRS, which is newly published, provide some guidance to change the method or to change the accounting. In that case, we have to follow that. Next one, changes in accounting policy resulting from application of IS and IFRS that does not provide specific transitional provision. In that case, if they are not providing some transitional provision, if they're not providing some guidance, you will come to IS 8, and change in accounting policy is made voluntarily. In that case, we follow retrospective treatment. Retrospective treatment basically means what? You should do the adjustment from the day one when you started the business, or the from the day when you purchased the asset. Now, normally see in your IS 16, we follow cost and revaluation model. Once we shift to revaluation model, do we apply retrospective treatment there? Even though cost model, revaluation model is accounting policy. When you're changing accounting policy as per IS 8, we should follow what? Retrospective. But we are not following retrospective treatment there. Why? Because it is specifically mentioned in IS 16 that you should follow prospective. If any standard is saying that even though the change in accounting policy is there, and the standard is saying that you have to follow what? Prospective treatment, you have to follow that. Now, retrospective treatments. Retrospective application means what? The opening balance of each affected part of the equity for the earliest period presented is adjusted. So, earliest period presented means what? This is my current year. This is the previous year. So, this year there is a change. Then, what will the company do? It's a change in accounting policy. Then, the company will normally do what? The company have to do retrospective treatment. Retrospective treatment basically means what? We have to do the changes. How will the company do the changes? See, the company will do the changes from the day one when the business started. Now, is it possible to do? Yes, if it's possible, the company should do. If it's not possible, the company will not do. If it is not possible to do from the day one, the company will not do. If it's possible, then no issues. But if it is not possible, then the company will do what? The date, the date from which it is possible to do it. The date from which it is possible to do the accounting, please do it. The IS says. So we have to do it. Excuse me. Now, what should we do? Now, will the company present? Will the company go and do the changes for each and every balance sheet? No, it will cost more. So you have to apply the conceptual framework, cost benefit analysis here. So what we do, we calculate the difference here. Then we adjust to the earliest period presented. Normally, this is the current year. Now, previous year balance sheet also will be given. Can I say why? For comparison purpose. Yes or no? So, which is the period which is presented when the annual report or when it is given for comparison purpose? We say previous year. So, this previous year, on this previous year, that is 1st January 2000 x4, we prepare a balance sheet. We prepare a balance sheet. Here also we prepare a balance sheet. Here also we prepare a balance sheet. This balance sheet is known as third balance sheet. This is the concept of third balance sheet, which is prepared in what case? Is prepared in the case of your retrospective treatment. So whatever is the adjustment from the day one till this day, it is done here. After this, the changes are made to the respective financial statements. So I hope this is clear to everyone. If it is not practicable to apply the effects of a change in policy to prior period, the change is made from the earliest period from which retrospective application is practicable. The standard says that only the date from which it is possible to do the retrospective treatment, do it. Now, now see here, I have taken an example. Company follows FIFO method for valuing the inventory. Company plans to switch to weighted average cost to value. Now see here, if the company is following FIFO and weighted average cost. So see now, for FIFO, there we go. So how much is this? 10,000, 20,000, and you have calculated the profit. Your profit comes to 18,000. Now, and revenue is how much? 40,000. If the company shifts to weighted average cost, the profit figure will be 17,000. Will be 17,000. So can I say the profit figure is affected here? So this profit figure should be adjusted. So the company decided to use what? Weighted average cost. In that case, where will the adjustment be done? The adjustment will be done in retained earnings. Your opening balance sheet. This is for example purpose I mentioned. Retained earnings will take minus 10,000. You will record it. So this is the way. Retrospective treatment will always be done in retained earnings and it is shown in changes in equity, statement of changes in equity. So see here now the example which I have taken, a very good example to understand the adjustment here. Now I say this is the year 31st 12 2007 and this is the next year 31st 12 2008. Now the company is following old policy is what? Weighted average cost. The company is following weighted average cost. The company wants to shift to FIFO now. The company wants to shift to FIFO. So if the company is shifting to FIFO, can I say the value of inventory is increasing? The value of the inventory is increasing. Now the company decided to do the change on what day? The company decided to do the change on this date. The company mentioned that we will shift from weighted average cost to FIFO. So now FIFO. In that case, can I say the adjustment should be done from the day one? Day one. Now it is not. If it is possible, we should do. If it's not possible, the date from which it is possible, you have to consider. Now see the retrospective impact. Now here I mentioned that 5,000 is the value of the closing inventory. Here FIFO it is 7,000. So increase in inventory is how much? 2,000. So can I say if your closing inventory is increasing, what will happen? Closing stock increases by 2,000, then profit will also increase by 2,000. Because if your closing inventory is increasing, can I say the cost of goods sold will come down? If the cost of goods sold will come down, the profit will increase. Now this is for the previous year impact. Can I say now see this is the year? No, this year the company have already calculated the profit for the first year, second year. The company has calculated the profit using what? Calculated the profit using your weighted average cost. But now the company is saying that we have to recorrect it. In that case, how is the adjustment done? So can I say till this for this year, what we do? We do the adjustment of 2,000. We increase the balance of retained earnings. So can I say on this day, what will I do? I will increase the retaining. Now, can I say on 1st January 2008, can I say the company would have taken the opening balance at the company would have taken the opening balance as 5,000, but the opening balance should be how much? 7,000. Can I say if the opening balance is increasing, your profit will come down? So we reduce the profit by 2,000. And then at the closing, what is happening, sir? 4,000 is the difference. So can I say the inventory is increasing by 4,000? If the inventory is increasing by 4,000, your profit will increase by 4,000. So the net is how much? The net is 2,000 increase. The increase for the next year is how much? 2,000. And till previous year, what is the adjustment? 2,000. I hope everyone have understood how retrospective treatment is done. Now, what are the disclosures that should be given? Nature of change in accounting policy, reason for change in accounting policy, what is the reason, why did you change from FIFO to weighted average cost? Then, effect on current and prior year due to change in accounting policy. If the accounting policy change, what is the effect in the previous year and in the current year? If retrospective application is impracticable, disclose the reason for the same. If it's not practicable to do, disclose what is the reason here. When a change is due to a new IFRS, the following information must be disclosed. That means I mentioned first we had IAS 18 regarding revenue. Now we have IFRS 15. There is a shift. So when there is a shift, no, we see the transitional provisions which are mentioned in IFRS 15. Because in IAS 18, the accounting for construction was different. Now in IFRS 15, it is different. So when you shift, no, you should mention what is the title of new standard, what is the name of new standard, what is the nature of change in policy, what is the major change. You have to mention that. Because of this major change, how will this affect your balance sheet and P&L? You have to disclose it. This is the disclosure for your accounting policy. Now coming to accounting estimate. Accounting estimate means what? Many entities. Can I say accounting estimate, when we prepare our balance sheet and P&L, a lot of items are based on estimate, like your useful life, residual value, a lot of things, future cash flows, etc. So accounting estimate. Many items in the financial statements cannot be measured but can only be estimated. Can only be estimated. Estimation involves judgment on the basis of latest available and reliable information. So, can I say estimate will be changing? Why will estimate change? A simple point. Estimate will change because estimate, if I estimate something today, I will estimate based on the information which I have. And if after 2 days some new information is available, in that case my estimate will change. Yes or no? My estimate will change. So estimation will change based on the information that is available. That is the reason whenever there is an accounting estimate, at each balance sheet date or reporting date, we consider the estimate value whether it's changing or not. Example: bad debts, inventory obsolescence, useful life, residual value, method of depreciation, warranty obligation, etc. So now, sir, accounting for change in estimate. Now, when there is a change in accounting estimate, do you do retrospective treatment? No, we do prospective treatment. That means from this day only we consider the change. In your IAS 16, we had done this for depreciation calculation. Prospective recognition means that the change is applied to transaction from the date of the change in the estimate. From today, you consider the change. A change in an accounting estimate may affect only the current period P&L or the P&L of the both the current period and future period. That means it will affect what? It will affect the current period and the future period. It will not affect the prior period. Understand that. Reason for change in accounting estimate is what? So the reason for change in accounting estimate will be what? New information is available, new development is there, more experience. When you used to do any estimate, you had very less experience. Now you have more experience. If you have more experience, can I say your estimate will change? Your estimate will change. Then, accounting estimate is treated prospectively because accounting estimate depends upon the availability of information, and this information was not available before. That is the reason prospective treatment. Because before we did not knew this information. If previously only we had knew this information, we would have considered it. But now the information is available for the first time. We'll consider prospective treatment. Note: can change in estimate be related to prior period? No. Whenever there is a change in estimate, it will not be a prior period error. That is, we have not done any error. At that time, we did not have the information only. So we did not include in the estimate. No, it does not relate to prior period and it is not an correction of an error. So change in the basis of measurement, whether a change in accounting policy or change in accounting estimate, it's a change in accounting policy. When you're changing the basis of measurement, like cost model to revaluation, it's a change in accounting policy, not a change in estimate. MCQ, important. When it is difficult to distinguish between a change in accounting policy and change in estimate, treat it as a change in accounting estimate. It is difficult for the entity to determine whether it's a change in accounting policy or estimate. Treat it as a change in accounting estimate. Then coming to disclosure, what are the disclosure years? Nature of change in accounting estimate, amount of change in accounting estimate, effects due to change in current and future period. Because of this change, what is the effect in current year and future period? If not possible to estimate the effect on future period, but facts must be disclosed. This was the revision for your accounting estimate. Now coming to prior period errors. That means what? In the previous year, some error was done. If in the previous year error is done, can I say what should we do? We should correct it. We should apply retrospective treatment. Simple. So prior period errors are omission from and misstatement in the entity's financial statement for one or more prior period. It can be more than 1 year also, arising from a failure to use or misuse of reliable information. That means we have not properly used the information that was available. Information that was available when the financial statements were made. See, information was available, but we did not use. That means it's an error and could reasonably be expected to have been obtained. Could reasonably be expected to have been obtained. That means this information was available. You did not knew. Now you know. So go and change it. Apply retrospective treatment. What are the types of errors? Some calculation mistake, mistake in applying the accounting policy, interpretation mistake in your IAS 10 adjusting non-adjusting event, omission and fraud. So in this case, these are the types of errors. What is the accounting treatment? Accounting treatment for prior period errors is what? Material errors are corrected retrospectively. If the error is material, then only we correct as per retrospectively. We do retrospective treatment. If the error is material, there can be two situations. Understand now. Error relates to earliest prior period presented. That means what? If I say this is the current year, this is the previous year which the company will present. Normally, the company will give 1 year balance sheet previous so that the comparison can be done by the stakeholder. Now I say the error was done in 2000 x4, x3, x2, x1. The error was done in this year 2000x1. Then what should we do? We have to do the adjustment, and the adjustment will be done on what? This balance sheet you're opening. So we prepare a third balance sheet here again. We prepare third balance sheet. So if the error is relating to what? The previous year of which? Previous of the comparative. In that case, we do retrospective treatment here and we prepare the third balance sheet. But if I say the error is relating to previous year only, if the error is relating to this year only, what will the company do? The company will normally change it. Change it. Will there be the concept of third balance sheet? The concept of third balance sheet will not come into picture. Will not come into picture. Understand? Error relates to earliest prior period presented. Restate the comparative amount of previous year SOPL. Restate the asset liability equity in the previous year. Restate the opening balance in the statement of change in equity. And third balance sheet is not required. That means this is related to previous year. The previous year, no issue to prepare third balance sheet. If error relates to period before earliest prior period presented. Restate the opening balance of the asset, liability, equity in the balance sheet, and third balance sheet is required. That means relates to the period. Which periods are earliest of the prior period? This is the prior period. I hope everyone have understood this part. Now disclosure, what are the disclosures? Disclosure is the nature of error, what is the amount of error and its effect in the financial statements. Then if retrospective restatement is impracticable for a particular period, the circumstances that led to the existence of that condition and description should be provided. That means if you're not able to do the retrospective treatment, provide the description, why, what is the issue, etc. So with this, your IAS 8 is completed. I hope this is clear to everyone. Okay. Now starting with the next standard, that is your IAS 37, provision, contingent liability, and contingent asset. So in this standard, what we will learn, in the standard we have covered the recognition criteria and measurement basis for provision, contingent liability, and contingent asset, as well as the disclosure that should be provided. So now see here, a scope. IAS 37 will address only provision which are liability, not allowance for reduction in value of the asset. So if I say provision for impairment, will this be covered in this chapter? No. Only for what? Provision which are liability. Normally we use the term what? Provision for depreciation, etc. We just add a name known as provision. That will not be covered here. Understand that. Only provisions which are liability. Excuse me. And provision for restructuring. When you restructure your business, Today only you know that in future we will have an expense. In that case, we will consider that. So what is provision? See the definition, sir. Provision is a liability of uncertain timing or amount. Either the timing, you do not know the timing or the amount. In that case, we say it's a provision. Then liability. Sir, what is the liability? Liability is a present obligation as a result of past event to transfer some economic resource. So the obligation can be two types: legal or constructive obligation. Now, when will you say the company has an obligation? The company will have an obligation when entity have no realistic alternative to settling that obligation. The company has no choice; they have to do the settlement. If the company can avoid that, that means there is no obligation. Understand? So, what legal obligation means? What legal obligation means? As per some contract or some laws and regulations by the government. So, constructive obligation means what? Constructive obligation means it's not written anywhere. It is based on some past practices like warranty. Normally the company in the contract it is written 1 year warranty, but if after 2 years you're going, the company is still providing the services to you, the warranty services. In that case, we say it is a constructive obligation because the company has been following this from the past. So it is an obligation which derives from an entity's action where by an established pattern of past practice, published policy, or sufficiently specific current statement, any statement they have given. In that case, we say constructive obligation will be that. And it should create what? It should create a valid expectation. It should create a valid expectation to whom? To the parties who are affected. Then recognition, sir. When we will recognize a provision? Provision will be recognized when there is a present obligation. Understand? Present obligation, the obligation can be legal or constructive as a result of past event. And present obligation, past event, it should be probable. That means more than 50% chance that the outflow will be there. And reliable estimate. If the four conditions are being met, we record provision. If not, no provision. Important note, a present obligation exists when entity has no realistic alternative but to transfer economic resource because of past event. There is no alternative. The company has to do settlement. And then what is the journal entry we pass? Debit, expense, credit, asset, asset in case of dismantling cost, and credit provision. So which category, sir? Respective category. If it is relating to business operating, if it's relating to financing, if it's relating to operating category, you record that. No such issue. The expense. Then measurement, sir. Measurement provision should be recognized at what? Best estimate. That means the measurement which you do, the value which you calculate should be on the best estimate. Because in provision, we do not know what is the amount we have to pay in future. So we do the calculation based on our past event, past practices, or past data which we have. So best estimate of provision will be two methods. Most likely outcome. Most likely outcome will be for one event, like court case. Either you'll win or either you'll lose. Provision, or we can use expected value method. Expected value method will be used for warranty provision, where the company will estimate, okay, how many goods or the number of items that can come for repair. So 100 products can come, 200, 300, 400. They'll see the percentage and multiply and calculate the value. Note, sir, should we use the present value concept? Yes, present value concept for provision should be used when the time period is more than 1 year. The time period is more than 1 year. So we do what? Present value, and we record it as an obligation. And over the years, what should we do? We have to unwind it and record it as a finance cost. The discount rate shall be a pre-tax rate. The discount rate will be what? Pre-tax rate, not post-tax rate. Pre-tax rate, MCQ, very important. Journal entry, debit expense, credit provision, debit finance, interest expense, credit provision, you record into financing category. With this, then, sir, provision should be reviewed at each end of each reporting period and adjust. The provision should be reviewed at each reporting date because provision is based on an estimate. An estimate will change. Whenever there is a change, we do prospective treatment, no retrospective treatment. If the provision is increasing, increase, record debit expense, credit provision. If the provision is decreasing, debit provision, credit income, simple. Then, sir, contingent liability. So now what does contingent liability mean, sir? See now, contingent liability means a present obligation that arises from past event but is not recognized. It's a present obligation. It's a past event. It should be a provision, but it's not a provision because the probability of the outflow is less than 50 percentage. It's not probable that outflow will be there. Or The amount cannot be measured. If the amount cannot be measured, will you be able to pass the journal entry? No. So you give a disclosure. It's or it's not and. Either one condition will not be met. We will record this as what? We will record this as a contingent liability and we will do disclosure, no accounting. Or the other definition, a possible obligation. It's a possible. The difference is what here? Possible and present. Present means you know for sure. Present means more than 50 percentage. Possible means less than 50 percentage. A possible obligation that arises from past event whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. That means you have to pay someone, but the payment which you have to do someone depends on some future event, and that event is not in the control of the entity. It's not in the control of the entity, so we say it's a contingent liability. Because you also there is no confirmation that there is an obligation. It depends on some future event, and then future event also is not within the control of the entity. So treatment for contingent liability, sir. So normally what we do, contingent liability, normally we contingent liability is disclosed unless the possibility of an outflow of resources embodying economic benefit is remote. If the possibility of an outflow is remote, then we will not do anything. Remote means we will not do anything. Which virtually certain, sir, what should we do? We should record it as a liability. If outflow is probable, then record a provision. What is a contingent asset? Same. It's a possible asset. The amount which you receive depends on some future event, and that future event is not with it's not in the control of the entity. It depends on some other things that the company cannot control. In that case, we say it's a contingent asset. So for contingent asset, what should we do? Contingent asset. An asset will be recognized if the inflow is virtually certain. If it's virtually certain, we record asset. But but normally contingent asset, a disclosure will be given. A disclosure will be given where the probability of outflow is that, not possibility, it is probable that the outflow will be that. That is 51 to 95 percentage. Entity shall not recognize a contingent asset in case of possible and remote. In case of possible and remote, there should be no contingent asset. Contingent asset will only be recorded when the outflow is probable, that is 51 percentage and 95 percentage. So see here now this one table. So sir, if outflow it's a liability, for inflow it is an asset. Sir, outflow is remote, less than 5%, do nothing. Sir, it is possible, then we do a contingent liability. Sir, it is probable, it's a provision. If amount can be estimated and it is probable. Sir, it is virtually certain, that then we say that it is a liability. So for inflow, if it's remote, we know that we will not receive. Chances are very, very less. Do nothing. We say it's possible, do nothing. If it is probable that you will receive the money, in that case, it will be what? Contingent asset. And if it's virtually certain, we recognize it as an asset, not as a contingent asset. We recognize a normal asset. So with this, the discussion regarding your provision, contingent liability, contingent asset is done. Now some special cases which are frequently tested in MCQ. Reimbursement. That means what? Today, if you're working for any company and you're paying for the petrol charges to travel to the client place, in that case, what will you do? You will give this bill to the company. You will say that you have to reimburse. In that case, can I say today only you know that it is an asset for you, because you know that for sure you will receive the amount. So reimbursement, can I say reimbursement will be by another party, like insurance company. If you have done any insurance, you have to receive from the insurance company, and here you have to provide any amount to someone else. So if I say let's take Raju is there. Raju has a court case. Now Raju is very smart. Raju is educated. So he have taken a insurance on this. Now Raju will lose this case and he have to pay amount. So can I say this will be a provision for him? And on the other side, he have done an insurance. So now he have to check whether the insurance amount he'll get or not. So it's like a reimbursement. So now see, in this case, some or all of the expenditure required to settle a provision is expected to be reimbursed by another party. Insurance payment. Recognition of reimbursement. Reimbursement is recognized only when it is virtually certain. If it's virtually certain, we record it. If it's not virtually certain, only disclosure should be given. Virtually certain, we do what? Recognize it as a reimbursement asset. If it's not, only provide disclosure. Accounting treatment. The reimbursement shall be treated as a separate asset provision. Raju has a case, so provision is there. As well as he is very smart, he have done an insurance on that. In that case, this is a provision, this is asset. Can he net it off? Net off is not allowed here. He can't offset it. He should record it separately. But sir, in P&L, can we do the net amount? Yes. Offset can be done in P&L. Offset cannot be done in balance sheet. Understand that. And then the amount recognized for reimbursement shall not exceed the amount of provision. My provision is how much? 10,000. But you know that you can get a reimbursement from the insurance company of 15,000. Can you record 15,000? No. You should only record 10,000 as a reimbursement. This is the first case for reimbursement. Then second, next one, onerous contract. Onerous contract means what's a basic. Onerous contract is a contract in which the unavoidable cost of meeting the obligation under the contract exceeds the economic benefit. If you remember your IFRS 15, we had done a step 1, step 2, step 3, step 4 for recognition of revenue in case of over the period. We have learned that if it is a loss, we have to book it today only. So same way, the economic, if you have done a contract, the economic benefit is low when compared to the cost. That means loss is that. So in that case, the present obligation under an onerous contract is recognized as a provision. How? It will be lower of two things. What is the first thing? Lower of cost of fulfilling it. So what is the ultimate cost? What is the total cost you will incur to fulfill the contract, or any penalty or compensation which you can pay to cancel the contract? Which one will be low? That amount will be recorded as a provision. Then coming to restructuring, sir. Restructuring means the company is doing what? The company is doing some changes in its business. So if the company is doing some changes in the business, can I say the company will incur cost? So today the company is saying that we will shut down the online business and we'll enter into offline business. Now today only, if the company is shutting down the online business, can I say a lot of cost will be involved? So today only the company knows that in future we have a cost. Can the company record a provision? Yes, when the criteria are being met. So see now, a restructuring is a program that is planned and controlled by management, and materially changes either the scope of the business. First, we are doing the business in retail, now we are doing the business in manufacturing, or the manner in which the business is conducted. That means first we are doing the business online, now we have shifted to online. So there is a change here. The business, there is a restructuring here of the business. What are the examples of restructuring? Like sale or termination of a line of business. We are selling one of the part of the business. Closure of a business location in one of the region. Let's take, I'm doing business in Jammu and Kashmir. I'm not doing now. I do the business in Delhi. I'm not doing. I concentrate only on south. Relocation from one region to other region. We are shifting our business. Then changes in management structure. There is a change in management structure. You're eliminating a layer of management, top level, middle level, you eliminate it. Then fundamental reorganization, which have a material effect on the nature and the focus of operation. You're reorganizing the business and which will impact the business, and the impact should be material. It should affect the decision of the users. So this is restructuring. Now, sir, accounting treatment. A provision for liability for restructuring is only recognized when the general recognition criteria are met. So what is general recognition criteria? There should be a constructive obligation. When there will be a constructive obligation, 2 points. A detailed formal plan should be there and valid expectation should be there. So detailed formal plan means a documentation should be done. Which part of the business is shut down, which location is shut down, the number of employees affected, what is the expenditure, when will the plan be implemented. And it should create a valid expectation to the entities who are affected. So valid expectation is created when the plan is implemented, or when the plan is announced to the parties affected. So two important principles, both this should satisfy, then only we'll say we can record it as a provision. The cost which will incur in future. Now restructuring provision amounts. Provision for restructuring can include only those expenditure that are both. Okay, provision for restructuring can include only those expenditures that are both. That means it should be necessarily incurred by restructuring. If you're doing the restructuring, you incur this cost. If you will not do restructuring, you will not incur. In that case, that amount only should be taken. If I do restructuring, I have to pay my employees extra amount. That is an expense. Then not associated with ongoing activity. The expense should not be related to the ongoing business which we are doing. So therefore, a restructuring provision cannot include. Certain examples are given which are frequently repeated in the exam. The cost of retraining and relocating staff. We are retraining and relocating them to do future business. It's not restructuring, or we are not shutting down the business. Then marketing cost, why will incur marketing cost? For future business purpose. Then cost of investment in new system, you are purchasing some new system, that is also for the future business purpose. Then operating losses, for operating losses you will not create any provision. Why? Understand. If today the company is saying that in future we will have losses, can the company create a provision? No. Why the company cannot create provision? Because provision should not be recognized for future operating loss, because it is based on future event, it's not a past event. And whenever there is loss, should you pay someone? There is no need to pay anyone. Understand? They do not arise from a past event, and there is no obligation. There is no obligation. So I hope the future operating loss is also clear. All these are tested for 2 marks or 3 marks in a single entity as well as in your MCQ. Then coming to the next topic, repair and maintenance. Now, repair and maintenance, in your IAS 16, we have covered now component accounting, major overhaul cost, yes or no, major inspection should be done, a lot of things. Now, today only I know that major overall cost will be there in the future, inspection should be done. Today only I know. But can I say after 3 years I have to incur this cost? Can I record this as a provision? No, better. This will not be recorded as a provision, because the company can sell the asset. If the company will sell the asset, will the company have the obligation? The company has an alternative here. It's not for sure that the company will incur this. The company can sell it, no? If the company sells the asset, there is no obligation. So this, for repair and maintenance, the company will never record provision. The accounting treatment is covered under IAS 16. The cost should not be provided for provision. Instead, IAS 16 will apply. For major components like replacement, every year we have to replace it, major overall cost, major inspection cost, all this will be treated as per IAS 16. No provision should be recorded. Then, sir, self insurance, a very good topic. Self insurance, what does this mean? Today I say I pay insurance amount on my car. I pay every year 10,000, 10,000, 10,000. Why do I normally pay insurance on this? So that in future if some accident happens, I can reclaim the amount, so I can repair my car. If I say in future there is no accident, will I get the money back? I will not get the money back. So the company will be very smart. The company will say that okay, we know our drivers are very good, there will be no accident. So instead of simply paying to the insurance company, if we pay to the insurance company, we will not receive anything. So the company will say what? The company will say that we will keep amount every year. We'll keep a small amount aside, saying that this is a provision. In future, accident will happen. We'll use this amount. You can't do self insurance. Understand that. IAS 37 does not permit the recognition of provision for such future expenses. Therefore, self insurance is a future operating cost that will be recognized when the actual expense is incurred. If accounting for self-insurance by setting up a provision for permitted, manipulation can be done. Simply the company will say that okay, in future cost is that is a this one, and in future period they'll reverse when the profit is low. So this should not be done. Hmm. So with this now, then decommissioning and other environmental costs we have done. Why? Either there can be a legal obligation or constructive obligation. Legal means as per law. If not, the company past practices were the past in the past years the company has followed this. That means they are dismantling, they are doing betterment for the environment. In that case, what should we do? We should capitalize this cost, and it will be depreciated over the useful life. It will be depreciated over the useful life. So see, these are the costs to dismantle or restore site when an asset is taken out of use. Common in oil and mining industry. A provision is required when there is a present obligation, legal or constructive. Legal means as per the government rule. Constructive means the company has been following from the past. If it's a mining business, then the provision is measured at present value. Yes, yes, we know debit, asset, credit, provision. So see, initially we record this value. Then what we record? Depreciation expense. Then we record finance cost. And once we settle, we remove the provision and we pay the cash. The other point, the cost is expense over time via depreciation. Normally, what do? You straightforward record it as an expense, but here we are recording over the period here. How? It is included in the cost of the asset and it is depreciated. Unwinding of discount increases the provision over time, similar to interest. Then unwinding discount should be recorded in financing category. So with this is also complete. Now coming to disclosure part. For provision, what are the disclosures, sir? What is the amount of provision you have recorded? Then what is the amount of unused provision? You have recorded a provision, but you paid a less amount. Then what is the additional provision during the year? Whether any provision has been discounted, mention that. Then give a brief, give a description about provision regarding which activity, etc. Then then you have to mention some uncertainty regarding this one, regarding the timing of the outflow or etc xyz, and the amount of any expected reimbursement with detail of asset recognition. If there is any reimbursement, that also you should provide, whether it will be an asset or not. If it's an asset, why do you say it's an asset? It's virtually certain. What is the evidence? Provide that or disclose it. In case of contingent liability, sir, in case of contingent liability, if it is remote, do we disclose it? No, we do not. But whenever there is a contingent liability, what a brief description of the nature of the contingency should be given. Why do you say this is a contingent liability? Then, where practicable, the uncertainties which are affected to expected to affect the ultimate outcome. If there could be some uncertainty, no, these uncertainties will affect your future cash flow. If you are able to predict it or it is practicable to do it, provide the data, provide the disclosure of that also. Any estimate of potential financial effect, if there is a financial problem, because of this in future, there will be a huge financial impact, disclose it. The possibility of any reimbursement, if there is any reimbursement, and it should be, it mentions the possibility of reimbursement, disclose that also. Contingent asset, sir, when will you record contingent asset? When it is probable. A brief description of the nature of contingency. Why do you say it is contingent? Why not an asset? Provide a description for them. An estimate of the potential financial effect where practicable. What is the financial effect because of this? Will there be a financial impact in the future? Yes, if you're able to estimate, record it. Provide the disclosure. Any doubts on this? So with this, we have completed your IAS 37 also. I hope it is clear to everyone. Chalo then. Now the last standard is IAS 10, a very small topic. Events after reporting period. This standard is very important for providing faithful representation, true information to the shareholders. So see here now. Definition. So what does event after reporting period means? Understand. Event after the reporting period. See here now the timeline. My start of the reporting period is 1st January 2024. The balance sheet date or the year end is what? 31st 12. Now after this, now is it possible for the accountants to make the balance sheet and P&L on the same day? The accountants or the management or the team, the accounting team will take few days to prepare the balance sheet and P&L, like 1 month or 2 months. Now, if they are taking the time, can I say they'll require 1 or 2 months? So in that 1 or 2 months, they prepare and it will be approved by the board of directors. Once it has been approved, can I say it will be published to the shareholders? And once it is published, after a few days, AGM will be conducted. Now understand, this chapter will apply only to the events which occur between this period. That is, from the reporting period, end of the reporting period, to the date of approval by the board of director. So what approval? Financial statement should be approved. Date of approval of financial statement by the board of director. Any event which occurs between this period and which provides evidence here and some conditions were there here. In that case, it is an adjusting event. If there was no condition here and the condition was also that was identified here and evidence also was there here, non-adjusting event. So CM. Events after the reporting period are those events, both favorable and unfavorable, which occurs between the reporting date and the date on which the financial statements are approved for the issue by the board of directors. So now types of event. Adjusting event. Adjusting event means what? Provide evidence of condition that existed. So condition was that, like condition was that one of my customer will not pay me. After 1 month, I got to know that bankruptcy, he'll not pay me. So it becomes an adjusting event. I have to do the adjustment. Then, sir, adjust the amount recognized in financial statement. In addition to this, also make separate disclosure for the same. You have to do the adjustment, also you have to provide disclosure. Non-adjusting event, indicative of conditions that arose after the reporting period. The conditions also arises after the reporting period, and the evidence also was after the reporting period. Then non-adjusting event, do not adjust the amount in financial, but if the non-adjusting event is material, then disclosure should be given. Understood? Non-adjusting event, we will only provide disclosure. For what? If it is a material event. Understand? So see here now, a lot of examples I've taken here. Settlement of a court case after the reporting date. So at the reporting date, you know that court case is there, and you know what is the amount. Yes or no? So you recorded an estimate. Let's say you recorded a provision of 2,000, but after, let's take 20 days only after your balance sheet date, you are paying 22,200. So instead of recording 2,000 as a provision, record 2,200. Payment is done next year. But the amount you have to readjust it. Then, sir, discovery of fraud and errors existed at the reporting date. Frauds and error will be there, so what should you do? You have to do the adjustment at the reporting date. And see, fraud is done, you did not knew, but condition was there. Fraud was done here in this. Before the reporting period, fraud was done, but after 20 days you got to know. In that case, what you have to adjust, because you got the evidence here. The condition or the fraud was done here, but you did not identify. Condition was there, we did not identify, but now we got the evidence and condition was that we have to adjust it. The next one, debtors suffering heavy losses before reporting it. So we get to know, okay, bad debt, it's that we will not receive the amount. So you'll do what? You'll record a loss allowance saying that, sir, we think that 5,000 will not receive, but after 1 month or 2 months you get to know that you only received 2,000. So the loss allowance you should record what? Of 7,000. You should adjust the amount. Then discount provided after reporting date on the goods sold before reporting date. That means you have received the asset, but the discount, uh, before your balance sheet date or reporting date, you have sold the goods, but discount is provided after that. That means what? Can I say your condition is that you will provide the discount, but sometimes you would see, no, in some entities what will happen, they say that if you purchase more than 10,000 units, you will receive discount. Till here you estimated that the company will never purchase, but after 10 days the company placed an order for 20,000 units. That means you have to provide the discount, so you have to adjust it here. So you got a evidence, condition was there on that date. Then, sir, determination after the reporting date of the amount of profit sharing. That means the company mentioned it was the policy that they'll pay the bonus, but on this date the balance sheet or the P&L is not ready. So will the company be able to calculate the amount? They will just estimate it. They'll just estimate, saying that okay, 1,000 will be the bonus. But once the balance sheet and P&L is ready after this, or the payment is done, they get to know, okay, the bonus was 1,200, so we have to record 1,200, not 1,000. You adjust it and provide a disclosure. Because why do we adjust it? Because obligation is there on the balance sheet date, reporting date, obligation is there. Then sixth one, determination of cost of asset after the reporting date, but asset was purchased before reporting date. That means you purchase the asset, only the amount, the purchase price or the amount which you have to pay, it's not available. That means you purchase the asset, but the supplier is giving you the invoice after 2 days. In that case, the condition was that we have purchased the asset, we have to record, but the amount we did not knew. We estimated, and once we receive the bill, we get to know the confirm what is the confirmed amount. You adjust it, adjusting event. Then, sir, sale of inventory below cost, providing evidence of NRV at the end of the reporting period. So normally, what do? You record cost and NRV. Here, the NRV you estimated, but after 20 days the value of the inventory, but after 20 days you are only able to sell, let's take 100, it is 80, you recorded 80, but after 20 days you are able to sell for 60. That means the NRV which you have estimated is wrong. You have to correct it, you have to change the amount, because evidence was there, condition was there, that there is a problem with this inventory, but confirmation came after 20 days after your reporting date. You have to adjust it. See now. Now, and non-adjusting event, what we do for non-adjusting event, only we provide disclosure. And what is the type of disclosure? The nature of event and estimate of its financial effect if possible. What is the nature of the event? Provide a description about the event as well well as say what is the possible financial effect on what in the future. Now examples. See for non-adjusting event the examples. Now a loss by fire after the reporting date. Was there any condition before the reporting date? No. Law fire will fire took place immediately and the condition was also at that time. Evidence also was at that time. So it's a non-adjusting event. Then change in fair value of the investment after reporting date. So the fair value is changing. Condition was not there, so you will not consider this. Then a major business combination after the reporting date. That means after your balance sheet date, you're doing a major business combination. This will be a non-adjusting event, frequently repeated in MCQ. Then sir, negotiation to acquire land started before reporting date, but transaction completed after reporting date. Your negotiation is done. You're doing the negotiation, but after the reporting date, the transactions, this is also non-adjusting event because is there any obligation here? Is there for sure condition that you'll purchase the land? No. So this becomes a non-adjusting event. Then announcing a plan to discontinue operation. If the company has announced the plan after the reporting period, your IFRS 9, will this be considered? IFRS 5, announcing a plan to discontinue operation. This also will be a non-adjusting event. So whenever it's a discontinue operation, the plan should be announced before that only, before your reporting date. Like in your restructuring also, we have two things: valid expectation and formal documentation. Both should be done before reporting date. Then only we say what? Then only we say it as adjusting event. If the announcement is done after the reporting date, non-adjusting event. Abnormally large changes after the reporting date in the asset price or the foreign exchange rate, it's a non-adjusting event. Then issue of new shares, loan notes after the reporting date. After the reporting date, we are issuing something, shares, bonds, etc. Non-adjusting event. Dividend declared after the reporting period. Two things are that: dividend proposed, dividend declared. Dividend proposed means it is just a suggestion by the directors whether we should pay the dividend or not. But dividend declared means what? It is declared by the, it is declared by the board of directors in the AGM. In AGM the discussion will be done and it will be decided whether dividend will be paid or not. So if dividend is declared after the reporting period, non-adjusting event. If the dividend is declared before the reporting period, for sure it is an adjusting event only. So see here now, step one and step two, what should you do? Check evidence of event after the reporting date, but before approval date. First, check whether any evidence is there or not. So evidence is there. Then check condition of such event existing on the reporting date. Check whether any condition was there regarding this or not. So with this also we have done a lot of examples which are frequently repeated. Now see here, special cases for inventory. Now condition existed on the reporting date, adjusting event. No condition existed on the reporting date, NRV falls due to price change in the market. Value of the inventory is going down. In that case, non-adjusting event. Then sir, no condition existed on the reporting date and fall in NRVs due to fire, water, leakage, etc. Non-adjusting event. So here what is important? No, you have to see if today we calculate the cost and NRV and something took place after this, it becomes a non-adjusting event only better. Because at this date, your reporting date, we did not knew that this will happen in the market. Now, can you predict that the NRV will fall down suddenly in the market? No. We can say, okay, in market, the price will fall by 5 to 10 rupees. But suddenly there is a fall of 100. It's a non-adjusting event because we did not knew that this will happen. The condition was not there. If the condition is there, adjusting event. For dividend, see now, for dividend, what should we do? So dividend declared before the year end are adjusting event. If the dividend is declared before the year end, it becomes an adjusting event. Dividend declared after the year end are non-adjusting event because it's no compulsory to pay dividend, so there is no obligation at the reporting date. Dividend proposed should be ignored because it's a recommendation. Even if it is proposed before the year end or previous, dividend proposed will not be considered. It's just a recommendation. Then, sir, last topic, going concern. If going concern issues that, let's take an example. This is your reporting period. Now add after, and this is approval date. Here, fire took place at the warehouse. Now this fire took place, the inventory, the fire took place at a warehouse. And in this warehouse, all the inventory was stored by the company. Now, in this case, now there is no inventory. Everything has been damaged or gone by fire. The company does not have any inventory. Now, if the company does not have any inventory, will the company be able to do the business? No, the company will not be able to do the business. So, going concern will be affected. In that case, this, even though the condition was not there, and but it is affecting your going concern, it will be an adjusting event. This will be an adjusting event. Which one? One, which one? Which one? Can you see me? Example one. This one, settlement of a court case.
Yes, sir.
Yes. Okay. See here now. Now you only say me. Today I say that Raju is there. Raju is a person. Court case is there on Raju. Can I say if court case is there, Raju will know that. Now Raju will talk with his lawyer, etc. Lawyer will say that you have to pay some amount. That means there are chances that you will lose the case. You have to pay. Now the amount which you have to pay, can I say it is an estimate? So your obligation was there. So obligation was that court case is there. We know that we have to pay. So he recorded a provision based on estimate of 1,000. But after 2 months, what happened? After 2 months, he's paying 1,200. Can I say your condition was there? Your evidence is that we are paying it. Evidence is that after reporting that we are paying it. Can I say on this day the condition was that we have to pay? But can I say the amount which I have recorded as a provision is wrong? So I will change it so that it provides better presentation to the shareholders, because I know evidence is there and condition is there, so we adjust it for better presentation. This standard works on the principle of better presentation for the shareholders, so that it provides all the information which is material at that time. When condition should be there on that date, on which date, reporting date or before that. Understood now?
Yes, sir. But
Yes.
I had a explanation. I mean, I had a doubt on this sentence that was there on the example one.
No, now it is clear now, I hope. Because it
Yeah.
confirms the obligation. We also know when we see
Okay.
whether my obligation is there, we also the obligation is also based on what we think. Okay, sir, probable present obligation. Present obligation means more than 50%. Okay, we have to pay. It gets confirmed after this, so we have to pay it. Simple. So with this, we
Okay,
have
sir. Got
completed the IS 10. See this standard IS 10. I say that when coming to practical world, it is easy to identify and it involves a lot of judgment. Information is required when you do the standard in a practical world. A lot of information is required so that you can make the right decision. But with a basic sense, when you go know, if condition is there, we knew but we did not record, we were waiting for something, we got the confirmation, please adjust it, record it, so the shareholders will get a better presentation. So with this, all the IS and IFRS we have completed. So with this, your IAS and IFRS is done. Your part 1, part 2, part 3, part 4, and in part 5, we have completed the cash flow. So tomorrow we can have a session for 2 hours. In that we can discuss the conceptual framework and regulatory framework, the theory part, and some your interpretation. I'll explain the ratios and I'll say what are the important points you have to focus. So 3 hours. We started at 6:10. Now it's 9:20. So we can end the session. It's Sunday. So I hope the session was good. Others, as you mentioned, we can't go in detail, we'll not be able to solve questions. But the aim of this marathon session was what? To revise the standards and to make you aware the mistakes which you will do in your exam. That was the important agenda or the aim of keeping this marathon session. So I hope you have liked this, and tomorrow we'll have a short session so that we can discuss this, the concept and regulatory framework, and the interpretation parts, or how to deal with that, etc. Understand one important thing: paper will be easy. I guarantee that. 70 marks paper will be straight for whatever if you have done. In our regular classes, we have done more than 30 to 35 section C questions and more than 400 MCQs we have done in the class. Then basic questions also we have done. A lot of things we have done in the regular class. If you have attended, there will be no such issue and you have given your marks, you have done a lot of question practice. So it's okay. And as mentioned, some questions will be tricky. So just seeing that, do not get panic. Sometimes what will happen, no, in section A, the first three questions only will be tricky. After that, everything will be easy. ACCA will do this. The first two MCQs will be tricky. So do not get panic. So with this, can we end the session now? I hope you have enjoyed the session. So let us keep one more session tomorrow so that we can complete the remaining part. So bye bye. Have a good day. Good night. Signing off. Radhe Radhe to everyone.